Very good morning, friends. So I hope all of you are doing well, and you've also made a little revision, if not much, on what we covered last time in terms of Indus 38. Though I'll be doing a little quick revision because a little pending aspect in terms of a few inputs to be given is still there. But I think before I take a quick recap in terms of what we have covered in Indus 38 so far, I think first of all, let's answer those small little MCQ questions which I gave you in the last class. Though I think I already got your answers in the previous class, but I think still, let me just declare the answers to that. Well, the first question which I asked you was regarding the negative list as per Indus 38. We've seen that Indus 38 gives us a certain items of expenditure which is prohibited from capitalization, which I technically call it as a negative list. And in this particular case, I gave you that the negative list is comprising of 4 items which are totally prohibited, and there is one item which is supposed to be conditional in nature. And I think this is absolutely a true statement, because if you recall the inputs which I'd given you that internally generated goodwill, that's 1. Internally generated brands, customer list, etc. That's number 2. Then training, advertisement, startup cost, relocation expense, number 3. And the research phase expenditure is supposed to be totally prohibited. But as far as a development phase expenditure is concerned, it is dependent upon a total of 6 conditions. So we can say, yes, there are 4 areas which are totally prohibited and 1 which is conditional in nature. So this statement is absolutely true. Good morning, Mani. Good morning, Sumit. Good morning, Abhilash. Okay, so 1 is true, absolutely correct. Thanks, Abhilash. Okay, then we go on to the next question with you. The second one which I gave you is that if the definition and the recognition parameters both are met, then apparently there are a total of 6 conditions which are required to be met. And yes, we segregated the definition in terms of 4 parameters and the recognition criteria in terms of 2 parameters. So this is also absolutely true. Then the third one, I gave you that if an intangible asset is acquired separately, not as a part of a business combination, then the 6th condition gets narrowed down. And I think I'm yet to work upon this with you. But I, of course, give you that there is an additional guidance which is given in the standard regarding the intangible assets which are acquired separately. And I give you that in those particular cases, not all the 6 conditions need to be evaluated. The list definitely gets narrowed down in this particular case because there is certain condition. Specifically, when you're looking at the probability recognition criteria and when you're looking in terms of the reliable measurement criteria, they get automatically met. We'll still work a little more on them because last time we could not finish that portion. So I'm going to still work a little more on that. So the number 3 is also absolutely true. And then number 4, it says intangible assets which are acquired as a part of the business combination. The 6th condition does not get narrowed down. Well, I think this is again a false statement, because when you're saying that assets are acquired as a part of business combination, we rightly remember that the probability recognition criteria and the reliable measurement criteria is undoubtedly met. So that was, if you remember, the para number 33, which we were talking of, and we'll give you some more inputs today on that. So the first 3 statements are true. The 4th one is false. And finally, we've got the 5th statement as well. And that's right, Rashmi. Good morning, Shailendra. Okay, so let's have a look now further on the last one. When you're looking at expenditure in a development phase, I said Indus 36 is applied if indicators of impairment are present. And I think this is false, because I told you that it's a mandatory situation where impairment testing needs to be conducted every time. So when a company is looking at a development phase expenditure, I very clearly give you the word, the expenditure is eligible for capitalization. So this is again a false statement. So the first 3 are true, and the 4th and the 5th one is supposed to be false. Okay. And when you said the third one is false, no, I'm afraid the third one is true. The third one, when I said the conditions gets narrowed down, yes, the conditions get narrowed down. The fourth one is false, and the fifth one is false. Okay. So far, so good on this. I think now let's take you further. And now I am going to first of all take a little recap in terms of what we've learned, because I just want to give you a little polishing ends. And then, as I promised, I'll give you a chart as well, that in which permutation combinations, which conditions need to be seen. So I think let me first of all give you a quick recap on things. I started off the journey in Indus 38 based on an overall three-step model. In the step number one, we were looking at the definition and the recognition parameters. Then in step number two, we're looking at the measurement initially and subsequently. And then the step number three is all about amortization. We've concentrated only on the step number one so far, wherein I gave you that there are two sub-steps. The first is that you need to look into, this is the main step number one, where I'm looking at the sub-step number A. You need to first of all look at the negative list, that is the item of expenditure a part of the negative list. And when I give you the negative list, I gave you that there is internally generated goodwill, that is para 48. Then there is supposed to be research phase expenditure, that is para 54. I'll not take para 57 in the negative list per se. Then I gave you the para number 63, where I gave you internally generated brands, customer list, methods, etc. Then the para number 69, which is training, advertisement, startup cost, relocation, etc. This is a pure negative list. And then there is another para number 57, which is dependent upon the 6 conditions for a development phase. If you fail any one of the condition, then it becomes a part of the negative list. But if you fulfill all the 6 conditions, then it is supposed to be eligible. So I said, if it is a part of the negative list, if you say a yes, the expenditure is undoubtedly revenue in nature. But if you say no, it's not a part of the negative list, then you need to go to the step number B. And in this case, we need to evaluate the recognition and the definition parameters. And in this particular case, I give you that the definition and recognition parameters is comprising of 4 plus 2, a total of 6 conditions, but I narrowed it down to a list of 5 conditions. And if you recall the 5 conditions, I give you out of the 5 conditions, the first one is identifiability. You need to first of all prove that the given intangible asset is capable of being sold, rented, or exchanged. And I also give you that if a particular intangible asset arises out of contractual or legal rights, this condition is supposed to be always met. Then I gave you the second condition, that is regarding the future economic benefits, which I made a total of 3 sub-conditions in that. I said the future economic benefit should arise, that is 1. There should be a more than 50% chance of its coming. It is probable in nature. And number 3, I said that this is supposed to be a case where the economic benefits will vary. So the B part is what we call the probability recognition criteria. And then I came to the third condition and I said, you need to prove that there is a control, a right to either restrict others from use, or you've got a legal ownership. Then I gave you a fourth condition. It is either completely intangible or it is predominantly intangible without physical substance. And finally, I gave you that the cost can be measured on a reliable basis. And the fifth condition, which I gave you, is supposed to be the reliable measurement criteria. So the second condition, that is 50% plus, is called the probability recognition criteria. And the fifth condition, the reliable measurement criteria. So this is what I gave you. And then I added on something further in this particular case. I said, having said that there are a total of 6 conditions which one needs to look into, but I said there is some additional guidance. And then I made a switch over in terms of changing your perception towards intangible assets. I said you can broadly divide the intangible assets into three categories from the point of view of looking at the definition and the recognition characteristic. The first one, I said, if there is an intangible asset which is internally generated, in which case my focus was more on the development phase. And when I came to the development phase, I gave you those 6 set of conditions. That is 2 plus 2 plus 2. Then I elaborated to you that if you fail any of the 6 conditions, the expenditure is revenue in nature. And if you fulfill all the 6 conditions as well, still the expenditure is going to be eligible for capitalization. And I explained that you need to mandatory basis conduct an impairment testing under Indus 36, wherein you need to see that if Indus 36 is met, then only you will be able to capitalize the expenditure. So not the entire expenditure may get capitalized, but then depending upon the recoverable amount, the expenditure gets capitalized. Then I gave you the second category in terms of intangibles where they are acquired on a separate basis, but not a part of the business combination. And I gave you that there is an additional guidance which is given in this standard. I'll give you the inputs very shortly again, that what is the additional guidance which is given for separate acquired assets. And then I said there is another asset which is acquired as a part of the business combination. And I also very clearly told you that if you acquire assets under a business combination, another thing which you need to keep in mind is the initial recognition takes place at a fair value. So when we initially recognize the intangible assets, we do it at a cost model, but then you can say there is an exception that if it is a part of the business combination, Indus 103 gets triggered and we consider the initial recognition at fair value. The cost in this particular case becomes the fair value. So I think now we're going to look at the additional guidance for the separate acquired assets and also the additional guidance for the assets acquired as a part of the business combination. But I hope, friends, till this particular stage, we are absolutely clear. I hope you have revised the things as well, and you are absolutely well connected with this particular thoughts, right? Okay, so now moving forward with you on this area. Now what I'm going to do, I'm going to take you to an additional guidance which is given in the standard for the 2 areas. And after that, we're going to make some wonderful list with you, a chart with you. And in between, we'll also do 1 or 2 more additional questions which have come in the RTPs. And incidentally, they've been also given in the education material issued by the ICI on Indus 38. So let me, I think, do one thing. First of all, let me just take you to a little more inputs in terms of what is given in the standard on this. So let me just share the text of the standard to you. Just a second. Let me just share the text. Just give me a second. So I'm just going to show you the text of the standard in this particular case, and we're just going to look at some relevant paras further related to this. Okay, so let me just share it back to you, and let's have a look at the inputs which are given for separate acquisition. Now, if you recall, I had given you that there is an input in para number 25 and para number 26. Well, for convenience, I'm looking at these inputs in the text of the standard. They're given in the study material as well. Now, let's have a look very carefully on para 25 and para number 26. Now, let me tell you, the focus is on a separate acquisition. Those intangible assets which are acquired separately, not a part of the business combination, but separate acquisition. Normally, the price an entity pays to acquire separately an intangible asset will reflect the expectations about the probability that expected future economic benefits, will flow to the entity. In other words, the entity expects that there will be an inflow of economic benefits, even if there is uncertainty about the timing or the amount of the inflow. In other words, we can say the probability recognition criteria, which is given in para 21A. I told you that para number 21 deals with the concept of recognition criteria. And one of the recognition criteria is the probability recognition criteria that future economic benefits will flow, and there is a more than 50% chance. It very clearly says is always considered to be satisfied for separately acquired intangible asset. So para number 25 makes it very clear that if you've got assets acquired separately, in those particular cases, the probability recognition criteria is always met. Then similarly, para number 26 also makes a mention. In addition, the cost of a separately acquired intangible assets can usually be measured reliably. Now, if you look at what is given in para 25, the word is very clear, is always to be considered to be met. And if you look at the para number 26, it says it is usually measured reliably. I don't think so. I need to overemphasize this part, that in para number 25, they very clearly said that it goes without saying that the condition is met. But in terms of the measurement, reliable measurement criteria, it says it is usually considered that it is reliably measurable. This is particularly so when the purchase consideration is paid in the form of cash or other monetary assets. Now, as I gave you last class as well, that when you acquire an intangible assets, it may be acquired for cash or it may be acquired by way of exchange. Now, if you acquire an intangible assets by way of cash, then this condition, that is reliable measurement criteria, is always met. But let's say, for example, if you acquired an intangible assets by way of exchange, then in this particular case, I would say it is usually met. So one would still need to make an assessment that whether the measurement criteria is met or not. So we can say the reason in para number 26 of segregating it from para 25 is that we cannot always say that the measurement criteria is met. We can say that if the consideration is in cash, then yes. If the consideration is by way of exchange, then probably you need to make an assessment. I hope I am pretty clear on para 25 as well as para number 26 on that end. Okay, now moving further to the next input. So before that, let me, I think, consolidate the picture now to you, and I think you can easily vouch me. So can I say if I'm looking at intangible assets which are acquired separately, not as a part of the business combination, then can I say out of the 5 conditions which I made, the list gets narrowed down to, now look at this, identifiability is still to be checked, yes. Number 2, on the future economic benefits, there were 3 clauses, they will arise, the probability is more than 50%, and they will vary. So I just need to see that they will vary, because the probability recognition criteria will be met, so which means they will arise, and the probability is more than 50%. So I narrowed down to ABC to just 1 clause that they will vary. You also need to evaluate the concept of control, and you also need to see that it is without physical substance. And in this particular case, it's also said clearly that as far as the 5th part is concerned, it depends. If the consideration is paid in cash, can I say I don't need to look at this particular condition? It is met. But if it is by way of exchange, then you need to evaluate the same, which means that if the intangible asset is acquired by way of payment in cash, effectively, how many conditions do you need to evaluate? Identifiability, economic benefits will vary, the control factor, and the physical substance. Can I say I need to look at only 4 conditions? And if you've acquired an intangible assets by way of exchange, then you can see the list is still comprising of 5 conditions. I hope I am absolutely clear. Though we have narrowed down the list, in terms of narrowing down the list, you can say the 2A and B is met. And you can say in terms of cash, even the condition number 5 is met. So you will have to look at a lesser number of conditions if the intangible asset is acquired separately. I hope I am absolutely clear on this parameter, friends. I guess I'm pretty clear on this particular concept that you are looking at intangible assets acquired separately. So what conditions need not be evaluated? They are supposed to be automatically met. We're going to put this as a part of a final chart also slightly later. Okay, now I'm going to take you to 2 more relevant paras, which relates to intangible assets acquired under a business combination. Okay, though I think I didn't get any input so far, that are we pretty clear with this particular part or not? I presume that we are clear with the conditions which have got narrowed down in terms of intangible assets acquired in a separate combination, in a separate acquisition, not a business combination. I believe that it is clear, though I didn't get any input so far. Oh my God, silence would mean a deemed acceptance to me for the time being. Okay, now let's go on to the next case where I'm looking at intangible assets acquired as a part of the business combination. So now I want to see that if they're acquired as a part of the business combination, then how do we narrow down the particular list? Now, for this purpose, we are given the para number 33, and I think just let me read a few things. In accordance with Indus 103, if an intangible asset is acquired in a business combination, the cost of that intangible asset is the fair value on the acquisition date that I've already given you. Now, it says the fair value of the intangible asset will reflect the expectations on the acquisition date about the probability that expected economic benefits will flow to the entity. In other words, the entity expects that there will be inflow of economic benefits, even if there is uncertainty about the timing or the amount of the inflow. Therefore, the probability recognition criteria in para number 21A is always considered to be met. He's again put the same language what was there in para 25, that the recognition criteria, the probability recognition criteria is always met. We don't need to evaluate that. Then he further says, if an asset acquired in a business combination is separable or arises from contractual or other legal rights, sufficient information exists to measure reliably the fair value of the asset. So the moment the intangible asset acquired in a business combination stems out of legal rights or contractual rights, even the reliable measurement criteria in para number 21B, it says, is always considered to be met. And generally, I would presume, unless mentioned otherwise, that when you acquire the intangible assets in a business combination, they would stem out of legal or contractual rights, which means that both the recognition criteria, that is probability recognition criteria, and the measurement criteria is 100% met. Which means if I'm looking at intangible assets acquired under a business combination, we can say, if you look at the 5 conditions, let's see which conditions doesn't need an evaluation. I need to see that is it identifiable? I need to see that it is identifiable. I would say no. If you remember, if a particular intangible asset arises out of legal or contractual rights, identifiability test is always met. So I don't need to see the identifiability test as well. In terms of future economic benefits, they will arise. It is implied. The probability is more than 50% implied. So I just need to see that the economic benefits will vary. I definitely need to see the control factor. And I think if they're arising out of legal rights, then I think the control factor is also met, right? Because if it stems out of legal or contractual rights, then I think you've already got the control, a legal ownership. So this factor also need not be seen. And then we are looking at the condition number 4, without physical substance, which can be seen. And in terms of the 5th one, that the cost can be measured reliably, we can say again, this is met. So we have indirectly narrowed down the list to how many conditions? You don't need to see identifiability. You don't need to see the control factor. You don't need to see the cost factor. So effectively, the list zeroes down to only 2 factors. I hope I'm making complete sense, friends, on that. I know I'm speaking technical, but to give you a clarity, we can see that the list of 5 conditions narrows down to effectively 2 conditions if the intangible assets are acquired in a business combination, right? Okay, so I think we got the inputs. It is wonderfully clear. Great. And show them you've got a question. So what is the treatment if someone else internally generated brand or goodwill is acquired separately? Well, you cannot acquire a goodwill of somebody else on a separate basis, but I can definitely say, to give you a clarity of thought, if company A acquires the internally generated intangible assets of B, B will not be able to reflect those assets in the balance sheet by virtue of Indus 38. But A would be able to reflect it as a part of its balance sheet by virtue of Indus 103. So I would put it like this, that internally generated intangible assets of one entity is a purchased intangible asset for another entity. So if I acquire the internally generated intangible assets of another company, then for me, it's a purchased intangible, and it definitely gets reflected in my balance sheet as a part of the acquisition accounting. I guess you got your answer. Okay. Now, friends, I think it's a right time to give you a very interesting chart. Based on a discussion in step number 1 on the definition and recognition parameters, and in terms of, giving you the inputs, additional guidance given on intangible assets, which are acquired separately or which are supposed to be, arising out of a part of a business combination. I think let's make a wonderful chart that how many parameters do you need to see? So I can do one thing. I can make a total of 3 charts, because otherwise I think the chart will get too messy. Or I can make a single chart as well, where I can take permutation combinations. But I think I want to consider a total of maybe 6 items. So I think let's take a single chart. Maybe we can condense the space, but this is going to be interesting to watch it in a single chart blow. So I'm going to put across questions. If you want, you can answer them, but I'll not keep asking you questions on that. Otherwise, the time will get delayed. So you can start answering questions on the chat box or on your mind itself. And I'm going to create a wonderful chart based on this. If you're able to relate to this particular chart, then I think my step number 1 is wonderfully taken care. So let me give you a comprehensive chart. You can maybe note it down. So I am giving you a comprehensive chart based on different permutation combinations, that what kind of factors do we need to see in terms of definition and the recognition criteria. So let me create a column, one column in terms of particulars. So one column, I'm taking particulars, where I'm going to consider the parameters of recognition. So I'm taking 3 columns. One is I'm taking internally generated. I'm taking internally generated intangibles. And here I'm not taking those negative list items. I am interested in considering the development phase expenditure. I'm interested in considering the development phase expenditure in this case. Then the second, another column which I'm taking is with reference to those intangible assets which are acquired separately. And when I'm looking at acquired separately, I am considering that it is based on legal or contractual rights. I'm considering that it is arising out of legal or contractual rights in this particular case. And then I'm also looking at if they're acquired as a part of a business combination. If they're acquired as a part of business combination, In this particular case also, I am again considering that they arise out of legal or contractual rights. And I want to also add another column, sub-column in the middle one. If it is acquired separately, I also want to see that if the acquisition takes place by way of a cash consideration, or if the acquisition takes place by way of an exchange and not a cash consideration. Wow. So I think we've got different permutation combinations coming in. Though I thought initially I'll take 6 things with you. Internally generated a part of the negative list, and then internally generated, that is research and a development phase. Then these are another 2, 5, and 6, but I think I eliminated them from the chart. So I'm concentrating on 4 areas with you. Internally generated development phase, acquired as separately for a cash, acquired separately by way of exchange, and acquired as a part of business combination, in which case I am presuming that it stems out of legal or contractual rights. Okay, let's begin the journey. Now, in this particular case, I am looking at the 5 parameters. The first one is identifiable. The first one is supposed to be identifiable. The second one is future economic benefits, in which I would consider effectively 2 conditions. Because if you say they will arise, then you're looking at the probability. The probability will take care of the fact whether they will arise or not. So one is that 50% plus condition, and one is that the economic benefits will vary. So the probability of the occurrence is more than 50% is 2A, and they will vary is 2B. Then I'm looking at the control factor. Then I'm looking at without physical substance. And then I'm looking at the reliable measurement criteria, that is cost. Okay, so let's start the journey. We've got a list of 5 parameters for definition and recognition, and I am now looking at one by one. If you've got internally generated intangible assets under a development phase, do I need to look at these 5 conditions? No. I am not looking at these 5 conditions. I am looking at the 6 conditions in this case. So you need to look at those 6 conditions and not these 5 conditions. So when I say those 6 conditions, I mean that you need to look at the 2 plus 2 plus 2, intention and ability, and then probability recognition criteria, and then the reliable measurement criteria. And you also need to consider the other 2, technical feasibility, adequate resources available. So in this particular case, you need to look at those conditions and decide. And in this particular case, you also need to conduct the impairment testing on a mandatory basis under Indus 36 and decide the fate. Simple and straight. Now let's come to the case when it is acquired as a part of the cash consideration. Now see the movement very carefully. If it stems out of legal or contractual rights, identifiability is implied, not to be tested. The control is implied, not to be tested. And then we look at the fact that if it is acquired for cash, the probability recognition criteria is not to be tested. And the cost is reliably measurable is not to be tested. Wow. I hope I'm making sense on every word of what I'm saying. It is undoubtedly identifiable because it arises out of contractual or legal rights, and it also proves the concept of control. It is implied. The probability is more than 50% implied, and the cost can be measured reliably implied. So what do I need to see? I need to see that the economic benefits will vary. I need to see that they are without physical substance. So effectively, the list narrows down to only 2 conditions, right? Effectively, you can say we need to evaluate only 2 conditions. Number 1, the economic benefits will vary. And number 2, it is without physical substance. So I think the list becomes easy. So if you get in the exam a separately acquired intangible asset, don't say that we need to evaluate 2, but you would say that 4 conditions are implied. You will say that the guidance given in the standard tells me that since it arises out of contractual rights, it is identifiable, the control factor exists, and in this particular case, the additional guidance is the probability recognition criteria is implied, always considered to be met. The reliable measurement criteria is always considered to be met. Right, friends? I guess we are going great on that. Okay, then let's go further. If you've acquired the intangible assets by way of exchange, then I would say again in this particular case, legal rights means identifiability need not be tested, control factor need not be tested, the economic benefits probability criteria need not be tested. But if it is acquired by way of exchange, this factor still needs an evaluation, that the cost is reliably measurable, because the standard says usually this criteria is met, particularly when the consideration is paid in cash. So this condition would still need an evaluation. So you need to look at the economic benefits will vary. You need to see that it is without physical substance. So the list in this particular case narrows down to 3. Aha, I like it. So which means in terms of acquired intangible assets, you got a list of either 2 conditions or 3 conditions effectively to be evaluated. Now let's come to the next case where we're looking at a part of the business combination. So in this case, when they are stemming out of legal and contractual rights, identifiability is not to be tested. The probability recognition criteria not to be tested, the reliable measurement criteria not to be tested, and the legal rights also proves the concept of control as well. So here again, you just need to see that the economic benefits will vary, and you need to see that the physical substance doesn't exist. So here again, the list effectively narrows down to a total of 2 conditions. Wow. So my presumption is being that the intangible asset stems out of legal rights or contractual rights. Then you just need to look at the effectively 2 or 3 conditions only. Right, friends? I hope I am 100% clear so far on the condition. So this was to give you a little extra edge in terms of the step number 1, that on a very apparent front, there are a total of 5 conditions. But if you look at the additional guidance given in the standard, we can say the list actually gets narrowed down to almost like 2 or 3 conditions, depending upon the case, the maybe. Right. I guess I'm pretty clear on that. Okay. That's wonderful indeed. So I think with these inputs in hand now, let's, I think, take the journey forward. My step number 1 is now completely done. Now what I'm going to do, I'm just going to pick up 1 or 2 sample questions with you before we go to step number 2. And trust me, step number 2 and 3 is not at all very technical. If you've got a little background in terms of Indus 16, then I think it's going to be pretty easy. With a few little inputs here and there, could be slightly different. So I think first of all, let's do one thing. Let's, I think, take you to a few questions at this stage. I'm first of all looking at a question which came in RTP in November 2020. So I'm sharing a question with you which came in November 2020. This particular question is there in the education material also issued by the institute. Let's have a look at the question number 10. It says ABC recruited a player as per the terms of the contract. As per the terms of the contract, and I think you know what you need to understand when I say as per the terms of the contract, that means there is a contractual right which is arising, which means identifiability seems to be met. The player is prohibited from playing for any other entity for the coming 5 years and has to be in employment with the company and cannot leave the entity without mutual agreement. The price the entity paid to acquire this right, indicates that it is supposed to be a separate acquisition and it is paid in cash. This right is derived from the skills and the fame of the said player. The price the entity uses and develops the player through participation in matches. So the economic benefits would arise when the player is going to play in the different matches. As many matches, as much benefits derive. So you know what my thought process is. State whether the cost incurred to obtain the right regarding the player can be recognized as an intangible asset as per Indus 38. Now, if you can answer this question, then I think your fundas are going very good. Effectively, how many conditions out of 5 do you need to test in this? Look at the facts very carefully. It's a case of a separate acquisition and not a part of the business combination, and the consideration will be taken that it's paid in cash. So effectively, out of the 5 conditions, how many conditions do you think we need to evaluate in this particular case? Okay, so I think we are getting, okay, Shobham, you said, so then this is a loophole to bring goodwill in the books. Well, that's purchase goodwill, friends. That's purchase goodwill. And Koshki, you said, so how is the 5th condition met in a business combination? The 5th condition is met because we read in para number 33 that a measurement criteria is met because you would acquire the asset by way of a fair value. So in this particular case, the para number 33 very clearly says it's met. And that's rightly said, so that's rightly said, Shomam. There are 2 conditions to be met. Great, super. So we can definitely say that 2 conditions are required to be evaluated. So I think let me still go through the process of my 5 conditions and how I would answer this question to the examiner. You can make an evaluation chart, and given that these are the 5, because this is not a case of a negative list question. So you need to look at the 5 conditions: identifiability, then future economic benefits, wherein we are looking at probability occurrence, and we're looking at that they will vary. And then you need to consider the control factor. And then there is without physical substance. And then we are looking at the cost. Now, I don't need to tell the examiner that we are effectively looking at 2 conditions, but you need to give him a logic as well. Now, I think let's explain how would we evaluate. We'll first of all tell the examiner about the identifiability, that since it is arising out of contractual rights, since it is arising out of contractual rights, we can say that as per Indus 38, identifiability is definitely met. That's 1. Then the probability recognition criteria, we will tell the examiner that since it is given in the standard, this is implied. And the economic benefits will vary because as many number of matches he plays, as much economic benefits I'm going to derive. So the future economic benefits is going to vary. The control again is there because since it arises out of contractual rights again, the control is also met. It is without physical substance because here we are looking at the skill of the player, which is to be recorded in the balance sheet. And the skill is something which is intangible in nature. And the cost factor is also something which is implied. So once you zero down on the evaluation chart, then you can give a conclusion that yes, it is eligible to be capitalized as an intangible asset in the balance sheet. Wow. So I think that was very interesting indeed. Super. So I think we got very good questions, answers from all of you. I think Koshki, Aniket, Marini, Sumit, Shobham, I think a wonderful performance indeed. One more question, then we go to the next one. Question number 11, which is again a question came in RTP in May 21. And this is also a question which is there in the education material as well. So I think let's have a look at question number 11 with you. It says PQR is a gaming developer company. Few years back, it developed a new game called Cloud9. It says few years back, it developed a new game. So the company is supposed to be talking of a game they've developed on their own. It seems to be a case of an internally generated intangible. Aha. When you read the language of the question, you should be able to correlate the category. Like, for example, in the previous question, we were looking at that it is a separately acquired asset. Now, in this case, it is developed a new game, which is supposed to be an internally generated intangible. This game sold over 10 lakh copies around the world and is extremely profitable due to its popularity. PQR released a new game in the Cloud9 series every year. The game continues to be the bestseller. Now, based on the management expectations, estimates of the cash flow projections for the Cloud9 video game series over the next 5 years have been prepared. And based on those projections, PQR believes that Cloud9 series brand should be recognized at 20 lakh rupees in its financial statement. Now, let me ask you, is this a case of an internally generated brand? Is it a case of para number 63, which clearly prohibits me to capitalize this expenditure as an asset in the balance sheet? Yes. So we can directly tell the answer to the examiner in this case that internally generated brand is something which is prohibited as a part of my negative list. So even if the management is able to get the projections of the cash flows, you cannot capitalize it in the balance sheet of the company. Then it says PQR also paid. Now he's talking of something else. He also paid 10 lakh to acquire rights of another video game. Now, when you are making a payment to acquire it separately, then it's a case of a separate acquisition. So 10 lakh is the amount acquired to pay another video game called the Headspace video game series. The said series have a huge demand in the market, and discuss the accounting treatment in the financial statement. Now, this is a case of a separately acquired asset, and you very clearly know that if it is a case of a separately acquired asset, there is effectively a list of two conditions, because in this case, the other factors would be either met because of contractual rights or are implied because of the additional guidance in the standard. So I think the only thing to be seen is that the economic benefits would vary, yes. And it is without a physical substance, yes. So I would easily evaluate and say that yes, it can be reflected as an intangible assets in the balance sheet of the company. Right, friends? So I think this is wonderfully met. So I guess all of you are pretty clear, and that was right, Shobham, and that's absolutely correct. Great. So that takes care of my first phase of discussion with you. That was the main step number one. I think we've given you enough inputs on the basis of which you can do all the questions on this area in the study material, though I've covered a few questions already with you. Okay, now I think I'm going to take the journey to the next area of discussion with you. That is my step number two. Now I'm going to the step number two, which is a discussion on the measurement aspects. So now this is a discussion based on my larger step number two. And I'm looking in terms of a measurement of intangible asset. So when I'm looking in terms of measurement, let me first give you a chain of thought on the basis of which I'm going to do my discussion. When I'm looking at the measurement, my first focus is the initial measurement, and then we'll talk about the subsequent measurement later. Now, when you're looking at initial measurement, there are different permutation combinations which should come to your mind. So let me take you to the study material. And I think let's have a look at that. When you are looking at the initial measurement of intangible assets, then what all are we looking at? And I'll be discussing each one of them one by one. So you can see, first of all, it can be a separate acquisition. It can be a part of a business combination. It can be a case of a government grant. It could be a case of internally generated goodwill. It can be a case of internally generated intangible assets, or it could be a case of exchange. So there are a total of 6 areas which are given for the purpose of initial measurement. And I think I've already covered the 2 areas with you. If you first of all look at internally generated goodwill, I've already given you that it cannot be recognized in the balance sheet of the company. Internally generated intangible assets, we've already discussed the 6 conditions of the development phase, and we've also seen how the impairment testing is done. So internally generated intangibles measurement aspects is already taken care. So I'm going to discuss basically the 4 areas of discussion with you, that if it is a case of a separate acquisition, then what is included or excluded? 1. If it is a part of a business combination, how do you record, though I gave you a fair value? And then there is a 3rd case, government grant and exchange. And I think I'll spend a little more time on the concept of exchange, because I typically feel that many people tend to get confused when intangible assets are acquired by way of exchange. Though trust me, the guidance in terms of exchange is exactly similar to what is given in Indus 16, or in terms of Indus 40, it is absolutely a similar guidance. So let's, I think, start with the 4 areas of discussion with you. So on the initial recognition, I'm going to focus on 4 areas with you. One is if it is acquired as a part of the separate acquisition. One is if it is acquired as a part of business combination. One is if it is acquired by way of government grant. And one is if it is acquired by way of exchange, then how do we tackle this issue? So let's start with, first of all, that if it is initially acquired, then what do we do? So let's have a look at the guidance given in the standard on this area. Well, if it is a case of a separate acquisition, the standard tells me that what is included and what is included are 2 components, as you can see in the study material. So this is page number 7.357 in the study mat, and it tells me what is included in the cost. So it says we consider the purchase price, including any import duties and including any non-refundable purchase tax. Trust me, this is absolutely similar to Indus 16, that you need to consider the purchase price, which is net of trade discount. You need to consider any kind of import duties or any kind of taxes which you pay, but they are not recoverable back from the government. And then the second is directly attributable cost. And the directly attributable cost is something which is unavoidable in nature, something which is required to be incurred in order to bring the asset for its intended use. So whatever cost the management needs to incur to bring the asset to a condition in which the management intends to use it, then we can say all that cost will be taken. So for example, any employee benefit cost, for example, any professional fees which might be paid, let's say to a lawyer for the purpose of registering the intangible asset. For example, if you're paid a legal expense to register a patent or a copyright for that matter, then it's a directly attributable expense. Even the cost of testing is also included the way it is taken in terms of Indus 16. So this is the list of items which are taken into account, and a similar kind of list is given, which is not to be taken as a part of the intangible asset. And the negative list which is not allowed is something like advertisement. So when you're introducing a product, there might be some advertisement promotional activities which is incurred. If there is any kind of a training cost which is incurred, you train the employee in terms of how to use a software, for example, it is not to be taken. And any kind of administration and general overheads are not taken. So the list of items which are not taken as a part of intangible asset is absolutely similar to what is given in Indus 16. So I think let's do one thing. We can just quickly document the inputs, what we need to keep in mind if the asset is acquired on a separate basis. So if a company acquired an intangible asset on a separate basis, we just have a very simple list of what is included and what is not included. So we can make a list of what is included. So in terms of what is included, we can say we need to consider, number 1, the purchase price. And when you consider the purchase price, we need to consider this net of trade discount. Absolutely similar to what we do in terms of PPE. Then we need to consider any kind of import duties which might have been paid. And we also need to consider any kind of taxes which are non-refundable in nature. So any kind of non-refundable taxes. So for example, if you're making a payment of a GST and you're going to get an input credit on the GST, then that is not to be taken into account. And we also need to consider any directly attributable cost. And when I'm looking in terms of directly attributable cost, we can say something which is unavoidable in nature. So for example, we said if there is any cost of testing which is incurred, if there is any cost which is incurred on account of professional fees, like for example, we said the legal expenses, the lawyer's fees which is paid, any kind of employee benefit expense which is paid. So all this will be taken as a part of the directly attributable expense. And then the list of items which is not included, that is excluded. And typically we can say that there are a list of 3 items you need to keep in mind what is not included. So one is, we can say, advertisement and promotional activity. One is, we can say, any kind of training expenditure which is incurred. And the other one is supposed to be any journal and administration overheads incurred. Any journal and administration overheads is not to be taken. As simple as that. Okay. So I think we can probably pick up one small little question based on this area as well, though this is pretty simple and pretty straight indeed. So I hope this is pretty clear. And somebody said, sir, is there any possibility of only one condition applied out of the list of conditions which I gave you? No, I think effectively the list narrows down to 2 conditions, I would say. Okay, now I think let's come back to the study material, friends. And I think let's have a look at a simple little question on a separate acquisition. So we are looking at the illustration number 4 in the study material on page 7.358. So this is on a case of separate acquisition. So what you can do, take a calculator in hand and you can start calculating the measurement at which the intangible assets will be initially taken. It says Venus India Private acquired a software for its internal use, which is costing 10 lakh. The amount payable for the software is 6 lakh immediately and 4 lakh in 1 year's time. Now, I didn't give you this, but I think you know this as well. You must have done this in terms of even inventory in Indus 2 or even in terms of Indus 16 in PPE, that when a company pays a deferred consideration, in this particular case, the money which you're going to pay after 1 year is supposed to be called a deferred consideration. So we always need to consider the present value of what you're going to pay. So this 4 lakh rupees is something which we're going to pay after a period of 1 year. So what we need to do, we need to discount this to the time value of money. So we will consider 6 lakh rupees in the cost of the asset, but we will take the present value of 4 lakh rupees and for which we need a discounting factor. The expenditure incurred is a purchase tax, so that would be taken. Then there is an entry tax, which it says in the brackets, it's recoverable later. So since it is refundable, it's not to be taken. Then there is a legal fees, which is directly attributable, that would be taken. There is a consultancy fees, which is paid for the implementation of the software, that is again will be taken as a part of directly attributable. And we given the cost of capital is 10%, which will be used for the purpose of discounting. Calculate the cost of software for the initial recognition. So what we're going to do, I'm just going to take a run through of the answer here. The cash consideration paid is 6 lakhs, that would be taken. Then 4 lakh rupees will be discounted at time value of money at 10% for 1 year. That comes to 363,636. The purchase tax is not taken because it is supposed to be, purchase tax is taken, but the entry tax is not taken because it is recoverable back from the tax authority. The legal fees and the consultancy fees is directly attributable. So that's how we get the answer. Simple and straight indeed. So this was a case when the assets are acquired on a separate business combination. Okay. Now let me come to the next part with you, friends. I know you've not covered the aspect of business combination accounting, but I think since there are a few questions given in the study material relating to business combinations, I think I just need to give you only a basic understanding to the extent required for Indus 38. I'm not taking you to business combination, friends. You're going to understand that standard separately. I'm just going to give you a flavor only to the extent we need to understand the questions in Indus 38. Now, just recall, you know what you've done in accounting standard 14 at the intermediate level. Trust me, a similar kind of accounting applies under Indus 103 as well. So let me take a very simple example that there is a company A Limited and there is a company B Limited. We are now discussing the concept of intangible assets acquired in a business combination. Now, let me give you some basic understanding so that we are able to do the questions on Indus 38. Now, hear me very carefully. This could be slightly technical for you, but it's pretty easy. A Limited acquired the business of B, what we technically call in Indus 103 that you acquired a control over the business of B. You acquired a control over the business of B. Now imagine this is the balance sheet of B. Imagine this is the balance sheet of B. So when A acquires the business of B, you're able to prove that it's a business combination. Then what A Limited needs to do, he needs to pass what we technically call an acquisition accounting entry. A Limited is supposed to pass under Ind AS 103 what we call an acquisition accounting entry. And the acquisition accounting entry looks exactly the way you do an entry in terms of accounting standard 14. So the entry would be like this. You will record the assets. The assets will be given a debit and the liabilities will be given a credit. So basically you take over the net assets of B. Now remember one thing, when you record the assets and liabilities which are there in the balance sheet of B, I don't need to consider them at a book value. My acquisition accounting entry will consider the assets and liabilities at a fair value, as I've already said. That as per acquisition accounting, when A would do the acquisition accounting entry, he will consider the assets and liabilities of B, which are appearing in the balance sheet of B at a book value, but they need to be recorded at a fair value. And secondly, it is not necessary that only those assets and liability which are a part of the balance sheet of B would appear in this entry. You can have other assets and liability as well. For example, internally generated intangibles did not appear in the balance sheet of B. But for A, if they become a purchased intangible assets and the criteria are met, then yes, of course, it will be a part of the acquisition entry. So A, while putting the acquisition accounting entry, will consider the assets and liabilities which are appearing in the balance sheet of B, or maybe not appearing in the balance sheet of B, but they will be taken at a fair value. And these assets will also be including the intangible assets of B, which may not be appearing in the balance sheet of B, as I said, because there was self-generated, internally generated, but for A, it becomes a case of acquired assets. And then correspondingly, A will pay a consideration, what we call a purchase consideration, and this purchase consideration will also be taken in this entry. Now, another important catch, which you're not going to see in terms of Indus 38 question is, there could also be something what we call an NCI that's called a non-controlling interest. Now, let me explain this slightly. It is not necessary that A acquires 100% control over B. When A acquired the business of B, maybe he acquired only 80% shares in that company. So if he acquires 80% shares in that company, then we can say he's got an 80% control. The remaining 20% is with the outsiders, and they are called NCI. They are called a non-controlling interest. So when you record this entry, we will consider 100% assets and liabilities of B. Even though A may acquire only 80% stake in the company, but you are supposed to put in this entry a full assets and liability. 100% assets and liability will be recorded. The consideration paid would be to the extent of 80%, and the remaining 20% belongs to NCI. So this will create a mathematical parity in the entry. Because net assets are 100%, the consideration is 80%, and the NCI is 20%. So it will create a mathematical parity. And then any balancing figure in this particular entry is taken as a goodwill, or what we call a capital reserve, the way you do it in AS 14. So the entry is quite similar to what you do in terms of AS 14, that when A acquires a control over the business of B, in this particular case, A is required to do an acquisition accounting entry. And as a part of the acquisition accounting entry, he would record the assets and liabilities. Whatever assets are taken over or the liabilities are assumed, they will be taken and recorded in this entry at a fair value. And then the purchase consideration, which is paid to acquire the control, will be taken. If there is any non-controlling interest, we'll give a credit. And then finally, any balancing figure in this entry will be taken as a goodwill, or we call it as a bargain purchase gain, or what we call a capital reserve. So this is all what you need to know in terms of the standard for Indus 38. Now, what would the examiner test you is in terms of Indus 38? He's not going to test your Indus 103 accounting entry. He would be interested in identifying that, whether a particular intangible assets will become a part of this list or not. Would it be a part of the acquisition accounting entry? And since, once you go for the exams, he knows that you've done Indus 103, he would also ask you to calculate the goodwill or the capital reserve in this entry, right? I hope, friends, I am pretty clear so far on this. Okay, and I think there is a question, what Shabam, you said, difference of business purchase, asset, liabilities, goodwill. Okay, that was an answer. That's absolutely correct. Okay, so now I think with this particular understanding, let's have a look at a question in the study material on this area. Let's have a look at the illustration number 5, which is talking of a business combination. So there are certain intangible assets which needs to be evaluated. So let's read the illustration number 5. Now, illustration number 5, I am given on 31st March X1, Earth India paid 50 lakh for 100% interest in Sun India. So we can see that the purchase consideration is 50 lakhs and there is a 100% stake acquired. So there is no NCI. It says on that date, the net assets had a fair value of 30 lakh. So on a very apparent front, we can say, if I don't read the question further, 20 lakhs is the goodwill, because the net assets at a fair value is 30 lakh, against which you paid a consideration, which is 50 lakh. So on a very apparent level, we can say goodwill is 20 lakh. In addition, Sun also had the following rights. He's talking of the intangible assets which are there with the acquiring company. It says trademark is named as Grand, which is valued at 1,80,000 using a DCF technique, a discounted cash flow technique. Now, in this particular case, if he's got a trademark, maybe it may be a self-generated trademark, but I think for Earth Limited, it certainly becomes an acquired intangible asset. And if it is an acquired intangible asset as a part of the business combination, how many conditions do you need to see technically? I would say we need to look at 2 conditions. One is that it is without physical substance. Yes, a trademark is definitely without a physical substance. And the economic benefits would vary. Yes, the economic benefits will definitely vary. So I think it can definitely become a part of the acquisition accounting. Then he says there is a sole distribution rights to an electronic product and the future cash flows are estimated to be 1,50,000 for the next 6 years. So he's again giving you that what are the expected cash flows and you need to discount them at a time value money. So discounting rate and the present value factor is all given in the question. So even the sole distribution rights would be something which is intangible and the economic benefits will vary. So I think both these assets can be a part of the acquisition accounting. So you can see the answer below. The question says we need to calculate the goodwill and other intangible assets. In this particular case, you can even put an entry or you can do a calculation like this. The net assets 30 lakh. To that, you add the trademark and you also add the distribution right, which is the present value of 150, discounted at the rate of 10%. And then you compare the consideration versus the net assets, you get a goodwill. I think it's a pretty simple and a straight question indeed. I guess you'll all be very clear with that. Okay, so this was the second area when the assets are acquired in a business combination. Now we go to the third area with you. So I have taken care of separate acquisition, part of business combination. Now let's come to the government grant, and then we'll do the discussion on the concept of exchange. Now, as far as assets acquired under government grant is concerned, I think it's pretty simple. Though you're going to cover this in Indus 20, but I think in one liner, let me just give you what happens when assets are acquired under government grants. The standard says that you could record them at a cost of acquisition. You can record them at a cost of acquisition if you paid a nominal consideration. So, or you can consider them to be recorded at a fair value. You've got a complete choice. The company can either consider recording the intangible assets at the money which is paid, even though it is a concession amount paid. Whatever is the concession amount paid, that would be taken. And the standard says that if you've acquired the intangible asset free of cost, then you can record it at a nominal value. The nominal value in this particular case is 1 rupee, or you can consider a fair value. So if you paid a concession amount, record the concession amount of the fair value, your choice. And if it is available free of cost, then you record it at a nominal value or fair value, your choice. Simple and straight. So there are no questions given on this area in the study mat because this is covered under Indus 20. Okay, now comes the concept of exchange of assets, where I feel, many students tend to go wrong. Okay, let me ask you, friends, do you also tend to get confused in terms of exchange? Does it sometimes put you to a confusion that when you acquire intangible assets by way of exchange, when do I take a book value? When do I take a fair value? What do I take? Do I take the book value of the asset given? Do I take the fair value of the asset acquired? Do I take the fair value of the asset which is given up? Do you tend to get confused in exchange? If yes, don't worry. Today, I'm going to give you my interesting two-step model on the basis of which I'm going to make your life jingalala. So if this, bothers you in terms of exchange concept, I'm going to give you a two-step model which works in any kind of asset-related standard, whether it is a case of Indus 16, exchange of assets, or Indus 38, exchange of assets, or even Indus 40, investment property. When there is exchange of assets, let's give you a very interesting two-step model on the basis of which you can try numerous number of questions in this area. So I think let me begin the journey with my two-step model on the concept of exchange. Now hear this very carefully. And once you get this, we'll do some questions with you. We'll do 2 questions with you in the study material, which is given on the concept of exchange. Now, first of all, let's understand one thing. There are 2 set of questions which you need to put across when you acquire an asset by way of exchange. So let's consider that I gave asset A, and in return, I acquired asset B. So let's consider that you need to first of all look into the fact that you gave A and you acquired B. Now, the very first question which you need to put across to yourself is number 1. Is there a commercial substance? You can maybe note it down as well. Is there a commercial substance? The first question which you need to put across to yourself is that is there a commercial substance of that exchange transaction? The question arises, what do you mean by a commercial substance? Now, from the examination perspective, this question is going to be pretty simple. When you say that there is a commercial substance, in simple words, you need to put across that did you exchange identical assets? Did you exchange identical assets, or did you exchange non-identical assets? You need to understand that are you exchanging apple for apple, or are you exchanging apple for orange? So let's say, for example, if you exchange, let's say, 2 assets which are similar. When I say identical, I say they are similar assets. I mean, just to take an example, not necessarily intangible. Let's say, for example, you exchange a building for a building. You exchange a warehouse for a warehouse. Now, when you exchange a warehouse for a warehouse, we can say they're similar assets. They're identical in nature. If the assets are identical in nature, then the concept of fair value does not apply. Remember, the concept of fair value does not apply. We need to consider B is acquired. We will record B at the book value of A. We will record the asset B acquired at the book value of A. So if you give A and acquire B, in this particular case, we will record and put the entry something like this. So you're going to put the entry in this particular case that B will be given a debit, and this will be given a debit equal to the book value of A. And correspondingly, you will give a credit to A, and this credit to A will also be given at a book value of A. So when you exchange identical assets, the entry is simply B will be given a debit and E will be given a credit. And remember, there cannot be any difference which can arise in this particular entry, because the debits and credits are being recorded at the same figure, because you're exchanging something which is identical in nature. So just put the entry, what you acquire is given a debit at a book value of what you gave, and you give a corresponding credit also at the book value of what you gave. Simple and straight. Now, if you say that the asset exchange is not similar, they're not identical in nature, now it's time to go to the question number 2. Go step by step. Trust me, you never go wrong. Now, when you go to the question number 2 in this particular case, in the question number 2, now I'm going to put across another question to myself. And the second question is, do we know fair value of both? The question is that you know the fair value of both asset given and acquired. You know the fair value of both the asset given and acquired. So we need to get this, that do you know the fair value of both A and B in this case? Now there could be various permutation combinations which could arise out of this. So the answer could be, yes, I know the fair value of both. I said, yes, I know the fair value of both A and B. Or the answer would be, yes, I know the fair value, but I know the fair value of only one of them. I know the fair value of either A, or I know the fair value of either B. Or the answer is no, I don't know the fair value of both of them. These are the 3 permutation combinations which could arise. So once you zero down that you're exchanging a non-identical asset, you would see that either I know the fair value of A and B both, or I don't know the fair value of A or B, or maybe I know the fair value of any one of them. Now, if you say that I don't know the fair value of either A or B, none of the fair value is given to me, in this case also, we cannot apply a fair value concept because we don't know what is the fair value. In this case, again, we will consider the book value of what is given. So we'll take the book value of what is given. So remember, we never consider the book value of what you acquired, and you cannot get a book value of what you acquired. So in this case, we will consider the book value of what you gave, because at the end of the day, the cost of acquisition is what do you give, what do you pay, and what I gave would be considered. Now, if you know the book value, if you know the fair value of only one of them, then you take that. Because I would consider the fair value concept in this case. We would consider the concept of fair value, and whatever fair value is available, that would be taken. If you know the fair value of A, take that. If you know the fair value of B, take that. So in this particular case, the entry will be B will be given a debit equal to the fair value of A or B, whatever is known to me. And I will give a credit to A at a book value of A. So there will be a difference which would arise in this case, and the difference will be taken to the profit and loss account, representing a gain or loss on exchange. So we will give a debit to B equal to the fair value, and we will give a credit to A to the extent of the book value, and we will take the difference in the profit and loss account. Now the question arises that if you know the fair value of both of them, then in that particular case, the management needs to decide which is more reliable in nature, unless mentioned otherwise. In this case, we always consider that unless mentioned otherwise, the fair value of what you gave is to be taken. Unless there is any evidence to the fact that the fair value of the asset acquired is more reliable in nature, we would always consider that the fair value of what you gave is more relevant in nature. So a similar kind of entry will be done in this case as well. I'll record B at the fair value of A and give a credit to A at the book value of A, and any balancing figure will again become a gain or loss. I think let's consolidate this before we do some questions with you on this area. So the moral of the story is that if your intangible assets or maybe tangible assets are acquired by way of exchange, you need to focus on a 2-question criteria. At the first instance, you need to see that is there a commercial substance or not. Now, when you're looking at a commercial substance, we're looking at, are you exchanging similar or dissimilar assets? When you exchange similar assets, the general presumption is that the configuration of the cash flows is not going to undergo a change. The cash flows which were expected from asset A and the cash flows which will arise from asset B cannot be, substantially different. So when a company goes in for exchange of similar kind of assets, we assume that there is no commercial substance and we would record the entry at the book value of what you gave. And when you apply the book value concept, there will not be any difference, gain or loss arising on exchange. But if you say you exchange a dissimilar assets, then in that particular case, you need to go to the step number 2 before you apply a fair value concept. You need to see that, do you know the fair value of both of them? If you know the fair value of both of them, then unless mentioned otherwise, more reliable base is the fair value of what you gave. But if you know the fair value of only one of them, then you consider the fair value of what you know. And if you don't know the fair value, then again, a book value concept would apply and you would take the book value of the asset which is given, right? I guess, friends, I am pretty clear on the concept of exchange in this case. Okay, I think Koshki said, yes, it confuses. And Shobham said, just the name of the ledger is changing. Okay, that's right. So I think, friends, now you would have become more clear with the picture. We can do some questions as well. I'm going to run this 2-step model with you on the questions we're going to practice. So I think, first of all, let's have a look at the illustration number 6, which is a very comprehensive question on the concept of exchange. Let's read this because we are required to do the entries, I guess, in the books of both the companies in this case. So we're going to look at the entries in the books of both the parties. It says Sun acquired a software from Earth in exchange for a telecommunication license. The telecommunication license is carried at 5 lakh in the books of Sun, and the software is carried at 10,000 in the books of Earth, which is not the fair value. So right now he's just given me the book value of these assets in the 2 respective books of accounts. Advise the journal entries in the following situations in the books of Sun and Earth. So I think what we're going to do, first of all, we're just going to make a little inputs as we solve. So I'm looking at the illustration number 6 in the study mat, page 7.362. So let me put this page 7.362. So we'll first organize the data carefully. And on this, we'll do the entries. So I'm looking at the books of Sun. So I'm looking at the books of Sun. Let's organize the data. And we're looking at the books of Earth. So I need to see what did he give. And I need to see what did he acquire so that the position is very clear. So my advice would be in the exam, first do that, get what he gave. It says Sun acquired a software in exchange of a telecommunication license. So he gave a telecommunication license and he acquired a software. And I think needless to mention that when you're looking at a telecommunication license and a software, is it similar or is it something which is not similar? It is not similar in nature. That means if I'm looking at the question number 1, there is a commercial substance. If there is a commercial substance, I need to now look at the information at a fair value. And if you look at the other company, Earth, we can say he gave a software and he acquired a telecommunication license the other way around. So the assets are definitely not similar. So everything depends upon the fair value information. Now let's read and answer 1 to 3. It says in point 1, the fair value of the software and the fair value of the license is given. Aha. If the fair value of both the assets are given, then we should apply the fair value of what I gave. Because I said, if you know the fair value of both of them, unless mentioned otherwise, we always consider that we should consider the fair value of what you gave. So can I say, now, if I look at the entries from the point of view of Sun, if I look at the entries from the point of view of Sun, he would put software account debit. And when he puts the entry software account debit, I need the fair value of the telecommunication license I gave. The fair value of the telecommunication license is given to me 5 lakh. So I would record this at 5 lakh. And then I will give a corresponding credit to my telecommunication license. And this will, of course, be given at a book value. And the book value of the telecommunication license is appearing at 5 lakh. Can I say in this particular case, it's just a matter of chance that no difference arises in this particular entry. Though we've recorded the software at the fair value of the telecommunication license, incidentally, the book value, fair value became same. So we did not get any difference in this entry. Now let's go to the entry in the books of the other company, Earth. Can I see in this case, Earth acquired a telecommunication license that will be given a debit. So in this particular case, in telecommunication license, we need to consider the fair value of the software. The fair value of the software is given to me 5,20,000. So we record it at the fair value of what I gave. And then I give a credit to the software, and the credit to the software will be given at a book value. And if you consider the book value of the software, it is recorded at 10,000. So in this particular case, we are getting a balancing figure, which will be taken as a profit on exchange, and it will be taken in the profit and loss account, that is 5.1 lakh. I hope, friends, I am pretty clear. So you can easily make the inputs that at the first instance, you should very clearly identify and make a list of what you gave and what you acquired. Then you go to your two set of questions. In this case, we are exchanging two dissimilar assets. So commercial substance is present. We go to the question number 2. And when I go to the question number 2, in that particular case, I said the fair value of both the assets are available. And if the fair value of both the assets are available, he applies the fair value of what he gave. He applied the fair value of what he gave. And then accordingly, we credit the book value and get the profit or loss on exchange. I hope pretty clear on this. Got it? Wonderful indeed. So let's now look at the second part of the question. Now, in the second part, it says the fair value of the software is not measurable, but a similar telecommunication license is transacted by another company. Now, in this particular case, since we know that a similar transaction is being accounted at a fair value of 4,90,000, then we can say this is reliably measurable. So we would consider 4,90,000 as a base to do the entry. So I think second one, I'm not really too much interested. But I guess you can simply see in this particular case that the entry in both the set of books is going to be at 490. So we can say in this particular case, if we do the entry, we can say in this case, you would record the software. The software will be given a debit, and this will be recorded at the fair value, which is 4,90,000. And the telecommunication license will be given a credit at a book value, and you get a balancing figure which will be debited to the P&L, loss on exchange. Similarly, the entry in the other person's books of accounts will also be at the reliable measurement base. So he would record the telecommunication license at 4,90,000, and he would give a credit to the software at a book value, which is supposed to be 5 lakhs. And you get a balancing figure, which is going to be, again, a profit and loss debit. There is a loss on exchange, which is, 5.1. This is, 5.1. The software will be given a credit to the extent of, 10,000, I'm afraid. So the software is given a credit to the extent of 10,000. So we're getting a gain of 4,80,000. So we get a gain of 4,80,000 in this particular case, which is credited to the P&L. So in the first transaction and in the second transaction, both we are following the concept of a fair value. If the fair value respectively is known, we took the fair value of what I gave. And if we know a similar kind of transaction, we apply the same. Now comes the third case. Neither the fair value of the software nor the telecommunication license can be measured. I think we've got no choice but to apply a book value concept. So what is the book value of the asset given will be taken. So when you consider the book value of the asset given, then I think there is going to be no profit or loss on exchange. And the entry is going to be simply with the same amount of debits and credit. So you can see the entry, though I think let me put this entry. So in the third case, what I'll do, the software will be given a debit equal to the book value of what I gave. The telecommunication license will also be given a credit to the extent of book value of what I gave. and the book value of what I gave is to the extent of 5 lakh. Similarly, the other company would also debit the telecommunication license and credit the software at the book value of what they gave. And the book value of the telecommunication license is supposed to be 10,000. Simple and straight, resulting in no gain or loss arising on account of exchange. I guess, friends, that's pretty simple and straight indeed, right? So this is done. We can take another small little question with you as well. So there is a small little question, which has got a little blend of a cash component as well. So I think the similar kind of question, I think recently came in the exams as well. This is given in the test your knowledge questions. So we can have a look at the test your knowledge question on this area. And that's question number 9 on page number 7.395. There's a question number 9 on page 7.395. So I'm looking at page number 7.395. There is a question number 9, and let's see how we're going to do this. So let's put across the 2 questions to ourselves. Let's read this question number 9. So the first important thing is that, when you're putting entries, do first of all make a list of what you acquired and what you paid. I think that's very important so that we don't go wrong. It says X acquired a patent right of a manufacturing drug. In exchange, X gave its intellectual property rights. So I think let's make a list of what you gave and a list of what you acquired, so we can clearly see that it is a similar or a dissimilar asset. So we given that he acquired a patent. So what he acquired is supposed to be a patent, and what he is given is supposed to be an intellectual property right. So he says that you acquired a patent right for a drug and it gave intellectual property right. So is this supposed to be a similar or a dissimilar asset? Well, intellectual property and a patents are not similar assets. If they're not similar assets, then in this particular case, we are going to the step number 2. So there is definitely a commercial substance. All needs to be seen that we know the fair value of what you gave and what you receive or not. It says currently the market value of the patent and the intellectual property rights are given. Oh, so we know the fair value of the patent also. We know the fair value of the intellectual property right also. So in this particular case, since the fair value of both the assets is given to me, so what do I need to consider appropriately? We consider the fair value of what I gave. I need to consider the fair value of the intellectual property in this case. So what would I do in this particular case? We put the entry patent account debit, give the entry patent account debit, which is the fair value of the intellectual property. He says the fair value of the intellectual property is 18 lakh. So you can record this at 18 lakhs and give a corresponding credit to the intellectual property rights, which will be given a credit at the book value. And it says at what value. Okay, I don't know the book value. It's not given to me. At what value the patent right should be initially recognized in the books of X. X did not pay any cash. So I think this is done. If a cash is not paid, I'm going to record this at 18 lakh. Now let's go to the next one. He says X also paid 2 lakhs to Y. So if you paid another 2 lakhs of cash, then you'll take 18 lakhs plus the cash component paid, then the asset is going to be recorded at 20 lakhs, simple and straight. So if there is an exchange without making any additional payment, then you consider the book fair value of what you gave. And if there is an additional cash which is paid, then it becomes 18 plus another 2 lakh cash paid, which makes it 20. Simple and straight indeed. Okay, so this is done. And I guess, Vinay, you said, if the entity acquired a software in exchange of convertible preference shares, how do you account for it? Well, in this particular case, the standard has not given us a guidance specifically talking that if the exchange takes place by way of shares, but I think given the guidance that you need to consider the fair value of what is given up, we'll always consider the fair value of what is given. But in this particular case, if you say that the fair value of what you gave is not reliably measurable, then I think the fair value of what you acquired would make more logical sense. Okay, I think Koshki tells me absolutely clear, wonderful. And when if software is acquired, okay, I think that was again the same question. I guess that answers your query. And Sumit, you said, so give and acquired to be taken as per the acquirer or acquiree, respectively. If I am looking at the books of Sun, for example, he gave something, you're looking at the fair value of what he gave. If you're looking at Earth, then the fair value of what he gave. So whose book you are putting the entry, you need to look at his perspective only. So what I give as a buyer is relevant to me. So if you look at books of A, look at A's point of view. If you look at books of B, look at B's point of view, respectively, right? Okay, so this was on the concept of exchange, which is given to you. So I think on the initial recognition, we're done with all the permutation combinations. I've covered the concept that if it is acquired separately, I've covered the concept if it is acquired under a business combination. I've covered the aspect if it is a government grant, and I've covered the aspect of exchange as well. That takes care of the initial recognition. Now comes the other aspect of discussion, and that is if you are looking at a case of a subsequent measurement, then what? And trust me, friends, if you're looking at a subsequent measurement, the accounting is 100%. I'm not even saying, 99%. It is 100% same as Indus 16. So I think all I need to do is just quickly give you the principles which are given in Indus 16. So we'll discuss and broadly summarize all those principles with you, that what are the various factors which we need to keep in mind when a company is doing a subsequent measurement. So let's begin the journey. So I guess you recall the principles which are given in the standard on this case. Okay, I think another question, I think Vinay, you said, if the software fair value is measurable, then preference shares will be recorded at a fair value of the software or fair value of the preference share as per 109. Well, I just gave you in my second step that there are 3 permutation combinations which could follow. So I think let me just remind you back on that. Well, as I said that there are 3 permutation combinations. Either the fair value of both what you gave and the fair value of what you acquired. If you know the fair value of both of them, we need to preferably consider the fair value of what you gave. So if you say that you gave preference shares, then in that particular case, you need to consider the fair value of what you gave. That means I'll take the fair value of the preference shares preferably if the fair value of both are given. Second, if you know the fair value of any one of them, that is the fair value of either what you gave or the fair value of either what you acquired, then you consider the fair value of whatever is known to me. And if you're saying that the fair value of the shares is also known to me, in those particular cases, I would consider the fair value of what I gave in that case, right? I guess that answers your question on that. Okay, so now moving forward to the next area of discussion, that is on the subsequent measurement part. Now, when I'm looking at the subsequent measurement part, the standard gives us a company an accounting policy choice. The standard gives us an accounting policy choice. And in terms of the accounting policy choice, the standard says that either you can use a cost model, you initially recorded the asset at a cost, or maybe the cost was equal to the fair value in terms of exchange or in terms of business combination. Subsequently, the company can either choose a cost model or the company can choose a revaluation model. And I think, let me recall the concepts to you. Can I say when you apply a revaluation model, let me ask you, friends, are you applying the concept of a fair value through profit and loss account, or are we applying the concept of a fair value through other comprehensive income? And you would record that whatever is the fair value changes, it is taken in the other comprehensive income. But let me now say something very clear to you. So this is something which you recall in terms of Indus 16 as well, but I think let me give you something at this stage. Can I say if there is increase in terms of fair value, you put that increase in the other comprehensive income. But if there is a decrease in terms of the fair value, then you put that decrease in the profit and loss account. I'm talking of a first time increase or decrease which takes place. So when there is increase in the value of the asset, you take it in the other comprehensive income. And when there is a decrease, you take it in the P&L. So can I say technically this revaluation model roots the item either in the fair value through other comprehensive income, or it roots it under a fair value through profit and loss account, as the case might be. Because when there is a change in the fair value and that increase in the fair value is supposed to be recorded in the other comprehensive income, it's like fair value through other comprehensive income. But if there is a decrease, you put it in the P&L account. So we can say we follow a fair value through P&L. And I think also to make a mention that when you put this in the other comprehensive income section, it comes with a no recycling concept. It is recorded in the no recycling concept. That means it is taken to the OCI section from where it will not be reclassified to the profit and loss at a later stage. Now, I don't know if you're very clear on the idea of how the movement takes place between the other comprehensive income and in terms of the SOKI. Do you want me to give a guidance? Do give me your inputs on that. Do you want me to take you to a run through in terms of how you're going to put it in the OCI section and how you're going to park it in the other comprehensive income? Then how are you going to tackle with this amount which is accumulated in the statement of changes in equity? Because this is the entire discussion as far as the revaluation aspect is concerned. So if you're comfortable, I think I'll leave that area. If you've already covered that in Index 16, or do you want me to give you a refreshing idea, then I can do that accordingly. So what do you say? You want me to give you inputs on that area? Okay, I think that was FPTPL. Okay, so that was a previous answer. So what do you want, friends, from me? You want me to give you a quick refreshing on the area that how do we put this in the OCI section? How does it get parked into the statement of changes in equity? And then what do we do at the end of the life of the asset? What do we do with that accumulated balances and SOKI? But if you're comfortable in India 16, then I think we'll not get into those nitty-gritties. Okay, I think Manadi says a yes. So I think first, I think on that note, I think you can keep sending your inputs on that. Maybe I think if most of you want it, we will give you the idea. So I think otherwise, let's do one thing first. I think let's give you a quick break on that. So we'll give you a 10, 12 minutes break, friends, on that. And then I think we can commence back with you. So let's take a quick break, friends, on 10, 12 minutes, and I join you back on this. Welcome back, friends. So I hope you had a mental rest as well. Now, as we were discussing before the break, we were discussing the concept of that once you subsequently measure the intangible asset, it is either taken at a cost model or it is taken at a revaluation model. It's the choice of the company. And in this particular case, we said that when you consider the fair valuation, the revaluation model, then any changes to the fair value at the year end, if there is an increase, is taken in the other comprehensive income, and that is with a no recycling. And if there is a decrease, it is taken in the profit and loss account. So I think first of all, let's give you a little connect in terms of how you're going to record this in the other comprehensive income and how is it going to get recorded in the statement of equity. How would you tackle this difference once over a period of time and at the end of the year? So I think that will take care of the aspects of the revaluation model as well. Yes, I think as per all your requests, I think I'm just going to do that as well. Okay, so first of all, let's, I think, give you a little extract position in terms of the profit and loss NOCI and in terms of SOKI. Now, before this, I think I'd like to give you a little insight in terms of the statement of changes in equity, because this is something, which we should look at from a little practical point of view. So let me do one thing, friends. I think I'll also like to share with you the schedule 3 as well, so that, we can get a very good connect. So just give me a second. Let me just relate the schedule 3 as well to you. So this is my schedule 3, and I am just going to connect you in terms of statement of changes in equity. Now hear this very carefully, and you'll get a good connect in terms of things. When I look at the statement of changes in equity, and typically I'm looking at the other equity, I always look at the statement of changes in equity, what I call SOKI, that it is comprising of 3 tabs. As you notice that in the first tab, we've got 2 items, the share application money, which is pending allotment, and there is equity component of compound financial instruments. Well, I would say my main concentration on the tab number 1 is the equity component of CFI. So we can say the equity component of the CFI is like the tab 1. Then the second tab is the reserve and surplus, and which is comprising of a couple of items, like we've got a capital reserve, there is a security premium, then there is other reserves and a retained earning. So that is the tab number 2, what I say, that is a part of the reserve and surplus. And then all the remaining items, as you see, whether it's a debt instruments or equity instruments or affected portion of the cash flow hedge or a revaluation surplus or exchange differences, these are all called the OCI tab. So you can say that when you're looking in terms of your statement of changes in equity, that is in SOKI, you can say your SOKI is always comprising of a 3 tab position. You don't apparently, call them as tab 1, tab 2, tab 3. But, if you look at this from a practical point of view, we can say there are basically 3 tabs. So I put it as tab number 1, I put it as tab number 2, and I put it as tab number 3. So when you're focusing on the tab 1, tab 2, tab 3, your mind should be clear that the tab number 1 is typically comprising of what we call the equity component of compound financial instrument. And I think to recall, if you've done financial instruments, which we did prior to this particular standard, you would remember that this equity component of compound financial instrument arises by virtue of the split accounting, which is given in Indus 32. And then if you look at the tab number 2, the tab number 2 is comprising of reserve and surplus, and which has got various elements, like it has got a security premium, like for example, it has got a capital reserve, and I would say mainly it's got another column which is called retained earnings. So the tab number 2, I would say typically is comprising of 3 items: security premium, capital reserve, and a retained earning. And the tab number 3 is items which are taken in the other comprehensive income. And if you look at the tab number 3, in this case, you'll see a lot of items. Like, for example, if you look at the tab number 3, you can see that there is a debt instruments through OCI, there is an equity instruments through OCI, and there is an effective portion of the cash flow hedge. And if you recall, all these 3 items were arising on account of Indus 109. When you've got debt investments measured at FPD OCI, that is R, or you've got equity investments measured at FPD OCI NR, or you're considering the effective portion of the cash flow hedge. Now you can see that in this particular case, there are a couple of standards which creates the tab number 3. There are a couple of items which enter the OCI through various standards and they enter in tab number 3. So we can say they relate typically, you can say to Indus 109, for example, because when you're looking at the debt instruments, the equity instruments, and you're looking in terms of the cash flow hedge reserve, they're all arising on account of Indus 109. Then you see we're given a revaluation surplus, and this revaluation surplus arises on account of Indus 16 as well as Indus 38. So you can see the other standard which creates this column is the Indus 16 or 38. When the PPE or the intangible assets are taken at a revaluation model, then this item gets created. There are exchange differences on translation of foreign statements, that is Indus 21. And then it says other item that depends upon the standard. So we can see that if you just try to correlate the picture, you would see that the tab number 3 is typically comprising of, you can say, items related to mainly 3 standards. It is either coming on account of financial instruments when you're applying Indus 109, or it is coming out of Indus 16 or 38 when a revaluation model is applied, or it stems out of the application of Indus 21. Well, right now, my focus is in terms of Indus 16 and 18. That is the item of revaluation surplus which arises in OCI. Now, I think let's take the picture further. So this is, as far as SOKI is concerned, that you've got 3 tabs. So basically, if I do a little more extended discussion on this area, then I can say, when you look at the tab number 1, when you look at the tab number 2, and you look at the tab number 3, this is more like the equity component of the compound financial instruments. Let's concentrate on the retained earning column, and let's concentrate on the revaluation surplus column. Since my area of concentration right now is on Indus 38, I want to explain the relationship of the tab number 2 as well as the tab number 3. And in terms of when you put it in the OCI. So let's take a very simple example and see how would you record items in the OCI, and then how do they get part in terms of the tab number 3 of revaluation surplus, and what is the connect in terms of tab 2. So let's take a very simple example. Let me take a very simple example to illustrate the movements to you. So let's consider a time scale, and let's break this time scale, let's say, in a period of 3 years. So let's say this is year 1, and let's say this is year 2, and let's say this is year number 3. So let's understand how the accounting flow will take place in the schedule 3 as well. So let's say initially you acquired an intangible asset at a cost. Let's say it was at the beginning of year 1. And let's say you acquired it at 4 lakh rupees. That was the cost. Now, on the first year balance sheet date, the company wanted to choose a revaluation model, and they decided to consider a revaluation model. And let's say the revaluation model tells me that 6 lakh is the fair value. Let's ignore any amortizations at this stage. Second year again, let's say I did a revaluation, and let's say now the revaluation works out, let's say to the extent of 9 lakhs. And let's say at the end of third year, let's take a further increase, and let's say the revaluation turns out to be 10 lakh. So this is how the revaluation is taking place. I'm taking intentionally an increasing trend without taking any downward revaluations at the moment. So you would consider a revaluation at the end of first year, second year, and third year. And let's say at the end of third year, this asset is also, let's say, finally sold. And let's say it is finally sold, let's say to the extent of 10 lakh itself on a very safe side. So the revaluation took place, and let's say it has been sold at 10 lakh rupees itself. Now, watch this carefully, what we are about to do. Now, at the first instance, I want to consider that if I am making my profit and loss and OCI, so I am now giving you the OCI section of the income statement at the end of the first year, at the end of the second year, and at the end of the third year. So this is my OCI movement. That is, what do you record in the other comprehensive income? Now, in the other comprehensive income section, there is a revaluation increase. So what I will do, I will take this revaluation increase and book it in the other comprehensive income. At the end of first year, from 4 lakh, there is an increase of 2 lakh rupee. So you put that 2 lakh rupees in the other comprehensive income. And this is also a part of the no recycling section. So I think if I just take you back on the schedule 3 and relate it to how it gets recorded in the income statement, you can see that in the income statement, you can see the point number 14. So this item is going to be taken as a point number 14A, items that will not be reclassified to the P&L. So you can say that this revaluation increase is being recorded as a part of like the 14A item. So you're going to put that 2 lakh increase in the OCI. Next year, there is a further increase to the extent of 3 lakh. So you put that 3 lakh in the OCI in the second year. Subsequently, again, there is increase of another 1 lakh rupees. So you put that 1 lakh rupees increase in the OCI. So this is how the increase gets recorded in the other comprehensive income. Now, let us also see how does the position appear in the statement of changes in equity. And I am typically looking at the tab number 3. I'm looking at the tab number 3, which is the revaluation surplus column. So I want to see that what is going to happen in the revaluation surplus column at the end of each year. This 2 lakh rupees, which was taken in OCI, is going to be recorded in the revaluation surplus column in the tab number 3 of SOKI. Second year, another 3 lakh is taken. So the cumulative amount will become 5 lakh rupees. 2 lakh was already taken in the SOKI. And then you can say another 3 lakh is taken. So the accumulated balance becomes 5. Next year, another 1 lakh is taken. So the accumulated balances adds up to a total of 6 lakh rupees. So your revaluation surplus column in the SOKI will give you a cumulative position. So the cumulative position at the end of third year is going to be 6 lakh rupee. Now, let's see what does the standard tell me in this particular case. At the end of the third year, if I look at the movement of the SOKI, this is my tab number 2, and this is my tab number 3. I'm looking at the third year end. The tab number 2 column is retained earnings, and the tab number 3 column is supposed to be a revaluation surplus. Now you've got a cumulative balance of 6 lakh rupees in the revaluation surplus column, and this will be directly shifted. This will be directly shifted to the retained earning. So we will reduce 6 lakh at the end of third year, and it will be a movement, what we call within equity. So basically, the total equity of the company would not undergo a change, but we will only move that item of 6 lakh rupee from the tab number 3 to the tab number 2. It's supposed to be a movement within other equity statement. But basically, what is the implication of this? Till the time the 6 lakh rupees was a part of the tab number 3, this amount was not available for distribution of dividends. And the moment it gets transferred to the tab number 2 in terms of retained earning, this money becomes available for dividend distribution. The standard also makes it very clear that it is not necessary that you wait till the end of the sale of the asset. I don't need to wait till the derecognition of the intangible asset takes place and then the entire cumulative amount at that stage is shifted to the tab number 2. They also give me an alternative choice. That what I can do, I can shift an amount from tab 3 to tab 2 on an annual basis as well. I can transfer an amount from the tab number 3 to the tab number 2 on an annual basis as well. But if you shift an amount on an annual basis, it is only to the extent of additional amortization, which means that let's say if the asset was not revalued, let's say if the asset was not revalued and I am looking in terms of what would have been the amortization. So let's say the amortization would have been, let's say to the extent of 80,000. And since you've done a revaluation, the annual amortization changes to, let's say, 95,000. So what you can do, you can see what is the additional amortization. Look at what is the extra amortization of the intangible asset. So 15,000 can be removed from the tab number 3 at the end of the first year, and it can be taken, shifted to the tab number 2 retained earning column. So the company has got two choices in terms of movement of the revaluation surplus, that either it waits till the end of derecognition of the intangible asset. So once you're going to remove that intangible asset from the balance sheet of the company, the entire accumulated balances can be shifted from tab number 3 to the tab number 2 at that particular stage, and it becomes available for dividend distribution. Alternatively, what the company can do, they can see that what is the additional amortization or additional depreciation, for example, on a PPE. See what is the depreciation, amortization you were taking earlier without a revaluation model, and see what is the amortization now taking place. So whatever is that additional amortization amount can be on an annual basis shifted from the tab number 3 to tab number 2. This will indirectly release, you can say that 15,000, and it becomes available for dividend distributions at the end of first year itself. So the exercise will continue at the end of second year, third year, and so on. The company can continuously, transfer the additional amortization amount from the tab number 3 to tab number 2 each year. Right, friends. So I guess I am pretty clear with the movements in terms of OCI. So when a company revalues an intangible asset at a revaluation model, then increases are taken in the OCI, and from the OCI it gets parked in the tab number 3 revaluation surplus column, and then from the revaluation surplus column it keeps getting accumulated, and the amount in the revaluation surplus can either be transferred one time at the time of derecognition, or it can be annually transferred to the extent of the additional amortizations which are there. Right, I guess, friends, pretty clear on this area. Okay, so I guess now what I'm going to do, I'm going to give you some notes on the revaluation model regarding certain considerations which we need to keep in mind. So I think let's give you some notes first of all to begin with. Let's, I think, document this with you. You can maybe note it down. So I am looking at the revaluation model. I'm looking at the revaluation model, and let's give you some insights on the revaluation model. Number one, when you apply the concept of a revaluation model, the first question what arises is the accounting treatment. And the accounting treatment depends upon whether it's a first-time revaluation or it is a subsequent revaluation. We need to put across a question that is it a first-time revaluation or it is supposed to be a subsequent revaluation. Now, if you say it is a first-time revaluation, then it depends upon whether it's an increase or whether it's a decrease. Now, if you say that it is supposed to be an increase, then what do you need to do? You need to give a credit to other comprehensive income. So we'll give a credit to other comprehensive income, and this amount in the other comprehensive income gets parked, you can see, in the tab number 3 of SOKI. It gets accumulated in the tab number 3 of SOKI, which is going to be under the head revaluation surplus. And if it is supposed to be a decrease, then in that particular case, we need to debit the profit and loss account. Then it doesn't enter the OCI, it is taken in the P&L. Now, let's make your life very simple, friends, on that. Because many times I've seen students also tend to get confused on the area. that if you are looking in terms of a subsequent increase, decrease, what do? Let's make your life simple. Now, if there is a subsequent increase or if there is a subsequent decrease, what do you need to do? You need to put across a very important question to yourself. If there is a subsequent increase, put across a question to yourself, did we debit profit and loss earlier? So if there is a subsequent increase, put that question to yourself, that did you debit the profit and loss earlier? If you say yes, we debited the profit and loss account earlier, you need to give a credit to the P&L to the extent of the earlier debit. So what do you need to do? We need to credit profit and loss to the extent of earlier debit. We need to credit the profit and loss to the extent of the earlier debit. So whatever amount was earlier debited to the P&L, you need to give a credit of an equal amount. And if still there is any further increase, then we can say we will credit the other comprehensive income, and that will be taken in the tab number 3 of SOKI. So get the focus very clear that if there is a subsequent increase, you need to ask yourself that did you debit the profit and loss account earlier? If you debited the P&L earlier, you need to give a credit to the P&L to the extent of the earlier debit, and then you give a credit to the OCI if there is any further increase. But if you say no, there was no debit to the P&L earlier, then in that case, you can simply credit the other comprehensive income, and that amount is taken to the tab 3 of SOKI directly. Now, coming to the next agenda, that is, if there has been a downward revaluation, if there is a decrease, you again need to put across a very important question to yourself. Do you have a revaluation surplus balance in the books of accounts or not? You need to be very clear on what kind of question you're going to put across to yourself at the time of the subsequent increase, decrease. So we'll put across a question, do we have revaluation surplus balance available? So you need to check your statement of changes in equity, and you need to put across a question that do we have a revaluation surplus balance? So the answer would be either a yes or the answer would be a no. Now, if you don't have a revaluation surplus, then the position is simple. You need to simply debit the profit and loss account itself. But if you have a revaluation surplus, you can first utilize that, and then you need to debit the P&L. So what we'll do in this particular case, we will utilize the revaluation surplus. We will utilize the revaluation surplus balance. That means you are going to make a debit to the OCI, and to the extent the balance is available. So utilize revaluation surplus, and then still, if there is any further decrease, then you can take it to the P&L. So what I've done, I've given you the crucial question which you need to put across at the time of subsequent devaluations or subsequent revaluation. So if you make a subsequent increase, go for the focus that did you debit the P&L earlier or not? Because you need to basically rectify the mistake done earlier. You need to give a credit to the P&L to the extent of the earlier debit. And then you can credit the OCI if there is any further increase. And in a situation, if you devalue the asset, then you need to see that do you have a revaluation surplus available? If yes, first utilize the same and then debit the profit and loss. This is one treatment, that is the accounting treatment in terms of things. Now, a few more aspects on the revaluation part. Number two, if you look at the standard, there is something very interesting. And this is regarding the frequency of revaluation. Unlike Indus 16, I'm saying unlike Indus 16, if you notice Indus 16 says that the frequency would depend upon, whether the revaluation change in the fair value is significant or not. So they say that generally, if it is significant, then you should do an annual revaluation. And if it says that if it is not significant in nature, you can do a revaluation once to three in 3 to 5 years, once in 3 to 5 years time. But if you look at Indus 38, Indus 38 does not give you any guidance in terms of the frequency of revaluation. So they do not give you any guidance in terms of frequency of revaluation. Number 3. The question arises, what do you do with this revaluation surplus? So we can say utilization of revaluation surplus. Now, when I'm looking in terms of utilization of the revaluation surplus, I've already given you during the discussion of SOKI that there are 2 alternative treatments available. In this particular case, there are 2 alternative treatments available. And the first alternative treatment is you wait. You wait till the end, till the derecognition of the asset takes place. So one is that you transfer the entire balance in revaluation surplus. You transfer entire revaluation surplus on sale of intangible asset. So once the sale of the intangible asset takes place, you're going to shift it. In this case, what do? You basically shift it from the tab number 3 column and you shift it to the tab number 2 column, that is in the retained earning column. So whatever accumulated balances are there in the revaluation surplus in the tab number 3 is going to be transferred to the tab number 2, that is at the time of the sale of the asset. The second alternative is that there is a transfer annually. There is a transfer annually, and this annual transfer is equal to additional amortization. It is equal to the additional amortization every year. So whatever is the additional amortization amount that is there, you can transfer that on an annual basis from the tab number 3 to the tab number 2. So this is on the utilization of the revaluation surplus. But remember, whatever amount you're going to transfer from the tab number 3 to the tab number 2, you cannot route that through the profit and loss account because it is a case of a no recycling. So this is going to be just an internal shift from one column to another column of SOKI without making any routing in the profit and loss account. The standard prohibits you that you cannot transfer this additional depreciation as a credit to the profit and loss statement. This is a movement which is going to take place only within the statement of changes in equity. Fair enough. I think that takes care of the revaluation model. I guess you must be pretty clear on the second aspect. So the second step is also over, where we've seen the measurements initially as well as on a subsequent basis. Okay, let's now take the journey forward, friends, with you. I guess we can maybe have a look at a small little question before I take you to the third section on this particular standard. And the only one of the good questions which came in the exam, which I am going to shortly do with you, is a question which came in January 21. In January 21, there was a brilliant question which came in the exams on Indus 38, and I'm going to give you a run through of that question very shortly. So I think first, let's take you to the study material, and I think we can have a look at one of the questions on this area. Let me just take you to the illustration part. So this is the chart, which is given in the study material, which I have actually given you a condensed version. So this is the study material chart on page 7.372. Okay, I think let's have a look at the illustration number 9 of the study material relating to this. So let's read the question with you. It says Saturn acquired an intangible assets on 31st March X1. It says for 1 lakh rupee. The asset was revalued at 1,20,000 on 31st March X2 and then at 85,000 on 31st March X3. Then there is another case which is given. Jupiter acquired an intangible assets on 31st March X1 for 1 lakh and the asset was revalued at 85,000 and on March X2 at 1,05,000. So we've given a little blend of initial and a subsequent revaluation. Assuming that year end both the companies are 31st March and they both use a revaluation model, Show how these transactions would be dealt in the financial statements. Explain the treatment for revaluation. Ignore any amortizations for the ease of understanding. So I think let's do one thing. Let's note down the movements in this case on illustration number 9. So there are two different cases, but we're looking at illustration 9, and accordingly, we'll put forth the question. So we're given in the case number 1 that on March X1, it was 1 lakh. So in case number 1, it was 1 lakh rupee. Then it changed to 1.2 lakhs. And then again, at the end of the third year, it became 85,000. So this is the movement number 1. Then there is a second case where we given a movement. And this is, it was 1 lakh rupee, it turned to 85,000. And then at the end of another year, we given the movement, it changes to 1 lakh 5,000. So it becomes 1 lakh 5. So now I think we can put across the questions to ourselves. So in this particular case, we are looking at the first revaluation, and then we are also looking at the second subsequent revaluation as well. So pretty simple and straight. Let's begin the journey. Can I say in this case, there is a first time increase? And if there is a first time increase, we can say this 20,000 is going to be credited to the other comprehensive income. It will be taken to the tab number 3 of SOCI. Then we come to the next movement. Now there is a decrease to the extent of 35,000. Now, when there is a subsequent decrease, what do you put across a question to yourself? Do you have a revaluation surplus with you? Yes, I have. So what I need to do, I will debit 20,000 in the other comprehensive income to the extent of the revaluation surplus available, and then the remaining 15,000 is going to be debited to the profit and loss account. So first, we will take care of the revaluation surplus balance available, and then you debit the PL. Simple and straight. Let's look at the second case. In this case, there is, first of all, a decrease. It's a first-time decrease. And if it is a first-time decrease, then this 15,000 rupees is going to be debited to the profit and loss account. And then there is increase after that. It becomes a subsequent increase thereafter. So from 85 to 1 lakh 5, it's an increase of 20,000. So when there is a subsequent increase, you need to put across a question to yourself that did we debit the P&L earlier? Yes, we did. So what do we need to do in this particular case? We need to give a credit to the P&L to the extent of the earlier debit. So we give a credit of 15,000 to the P&L to the extent of earlier debit, and the remaining 5,000, this is going to be given a credit to the other comprehensive income, which will again be accumulated in terms of the tab number 3 of SOCI. So I think both the movements are available. One case is focusing on increase followed by a decrease, and the other case is a decrease followed by an increase. So that takes care of the revaluation model. I think pretty simple and pretty straight indeed. Okay, Koshki, you had a question. So can we utilize a revaluation surplus pertaining to other assets in case of decrease? No. You need to basically maintain a revaluation surplus for each and asset separately. So the company will not be able to utilize a balance of one asset against the other. So you need to keep a track, and you need to keep a separate record for each asset. Right. So that was the illustration number 9. This is done. Right, friends. So I think this takes care of my step number 2 as well. So out of my 3-step model, I am done with the concept of the 2 steps with you. Now I'm coming to the 3rd step, which is pretty simple and pretty straight indeed. We'll do some questions also on that, but this is a pretty simple and a straight one. Okay, so let's now take you to the step number 3. Now, once you've measured the asset in the books of accounts, then comes the main step number 3, wherein we are deciding the concept of amortization. Now, I think one focus which needs to be kept very clear in mind. You know, when you're looking at amortization of intangible assets, there are a couple of questions what comes to the mind, but the first focus what we need to keep in mind is there are 2 kinds of intangible assets. One is which has got a finite life. One is intangible assets which has got a finite life. And one is intangible assets which have got an indefinite life. Now, I think at this stage, one thing I like to clarify, indefinite does not mean infinite. Many people tend to get confused and they interchangeably use the word indefinite as infinite. Let me tell you, indefinite does not mean infinite. Infinite means that the life is, going to be infinity. But when you're looking at indefinite, it means you can't capture the life, but it's not infinity. But it's difficult to capture the life of the asset. The standard makes it very clear that if you're looking at those intangible assets which have got a finite life, naturally they will be amortized over the useful life of the asset. We'll do an amortization. But those assets which have got an indefinite life cannot be amortized, so they will be covered under the aspect of impairment testing. So they will be tested for impairment, and this impairment testing is done as per Indus 36. And this impairment testing will be done irrespective the indicators of impairment are there or not. Indus 36 generally gets triggered only when the indicators of impairment are present, but this is supposed to be an annual impairment testing. This is going to be an annual impairment testing, which is mandatory in nature, even if there are no indicators of impairment. So I can say at this stage, if you recollect something what we discussed earlier, you can say intangible assets can be effectively seen from three perspectives. You can say intangible assets which are under development. Intangible assets which are under development are again impairment tested as per Indus 36, because they are not amortized, but there is going to be an impairment testing at each balance sheet date before they are ready. And even if you're looking at those intangibles which are already developed and they've got a finite life, they will be amortized as per Indus 38. And you've got certain intangibles which are already developed, but they've got an indefinite life. In this particular cases, also they are impairment tested. So you can say two kinds of intangible assets are tested for impairment. One is something which is under development, and one is something which is already in use, but it has got an indefinite life. Okay, so this is on the concept of amortization. Now, more considerations coming in. When you consider the amortization of intangible, the first thing comes regarding, you can say, what is the residual value? What is the residual value to be considered for the purposes of amortization of the intangible assets? The standard makes it very clear that unless mentioned otherwise, we generally presume, I'm saying generally, we generally presume, unless mentioned otherwise, that zero will be considered as the scrap value or the residual value of intangible assets. But the standard also makes it very clear that there are certain exceptions where the scrap value of the intangible assets will not be taken as zero. And there are two given exceptions. If your intangible assets has got an active market, if the intangible assets have got an active market, then in those particular cases, we can go in for a certain amount of scrap value, which can be derived from that active market available. Or the second exception is if there is a committed third-party purchase. If there is a committed third-party purchase, so if there is a third-party committed purchase at the end of the life of the asset, so the company has already entered into a contract with a third party who is going to buy this intangible asset. So if you've got a committed third party, you can consider a certain scrap value dependent upon what amount of guarantee the other person is given. But unless mentioned otherwise, if there is an absence of an active market or if there is any absence of committed third-party purchase, we need to consider the scrap value to be zero. That's one important input. Second, the second important question arises regarding the methods as far as amortization is concerned. That if an intangible asset is being amortized, so what is the method we need to consider? There is again a big misconception many students get at times, that when we're looking at the amortization method, they say straight line. No, it is not straight line. The company should always preferably the company should always, on a preference basis, consider the ratio of economic benefits. You should amortize the depreciable amount of an intangible assets. This is going to be in the ratio of future economic benefits. So if the life of the asset is, let's say, 5 years, get the economic benefits for the next 5 years and divide the, you can say, depreciable amount in the ratio of economic benefits. But if the ratio of economic benefits is not available, if the ratio of economic benefits is not available, then the standard says you can maybe use a straight line method for the purpose of calculating amortization. So the first preference will be in terms of the economic benefits ratio. And if that is not available, then a straight line method will be taken. Okay, so I think we have spoken in terms of amortizations or impairment. We have spoken in terms of the status of the residual value. We have spoken in terms of the method. And lastly, let's also put this out. The standard further says that when you're considering amortization, there are a couple of factors which would affect the amortization. One is, you can say, the life, that is the useful life of the intangible asset. The second is regarding the method of amortization. The third is regarding the residual value of the intangible asset. So the life of the asset, the scrap value of the asset, the method of amortization, and these are again supposed to be reviewed annually. There is a review of these things required at the end of each year. So the company is supposed to make an annual review of the useful life, the method, as well as the scrap value. And due to this annual review, if there is any change, this change is regarded as a change in accounting estimate. So if there is going to be any change in any of these parameters due to annual review, it is considered to be a change in accounting estimate as per Indus 8. And this change in accounting estimate is accounted for on a prospective basis. This is going to be accounted for on a prospective basis. It's prospectively accounted for. So you can say whatever is the depreciable amount of the intangible assets, that is going to be spread over the remaining life of the asset. But if you change, let us say, from a cost model to a revaluation model, in any of the subsequent years, if you change from a cost model to a revaluation model, this change is regarded as a change in accounting policy. So this is not the first year. I'm not saying that you're changing it for the first year, because when you change from in the first year, then the accounting is given in terms of Indus 38. But if there is a change from a cost to a revaluation model at a later year, it is called a change in accounting policy, because it was a policy to select the asset at a cost or revaluation model. And if there is a change in accounting policy, it is accounted on a retrospective basis as per Indus 8. There is going to be a retrospective accounting, but mind you, this change which I'm talking of is not the first year, it is subsequent change. Because when you consider the change at the first year, that means you acquire an intangible asset and you go for a revaluation model in the very first year itself, then there is no retrospective accounting. In that particular case, you just take that in the OCI or the P&L, as the case may be. But in subsequent years, other than the year of purchase, if there is going to be a change in the valuation model, then it is covered under Indus 8, and it's an accounting policy change accounted on a retrospective basis. Okay, so that was a look at the step number 3 regarding the amortization concept. And I think we can do a small little question based on this area with you. So I think let's take it further. Let me take you to the study material. And I think we can pick up one question on this area. I think that question is given in the test your knowledge area. So let me take you on the test your knowledge questions, wherein we've got one particular question on this area. 14 is on revaluations. Just a second. I think there was a small little question. I think maybe in the illustrations. Okay, here it is, I guess. Yes, this is a little comprehensive question. Illustration 11. No, we're taking illustration 10. Yes, illustration number 10 in the study material. That is on page number 7.386. Page number 7.386. And we're looking at illustration 10 on this area. So let's, I think, have a read on this illustration with you. Pretty simple and straightforward. It says X engaged in the business of manufacturing fertilizer entered into a technical collaboration agreement with a foreign company, Y. As a result, Y would provide the technical know-how, enabling X to manufacture fertilizer in a more efficient way. X paid a total of 1,000 lakhs for the use of know-how for a period of 5 years, and the estimated productions for a period of 5 years in metric tons is given. And then he says at the end of first year, the company achieved the targeted production. And at the end of second year, 65,000 metric tons was being manufactured. And X considered to revise the estimates for the next 3 years. So the company seems to be using what we call technically a UOP method, that's called a unit of production method, to amortize an intangible asset. In this particular case, I think the information is very clear that the company is using a production method, what we call a UOP. This is a similar method which you use in Indus 16 as well. It's called the unit of production method. So the company made a projections of the productions to be achieved in the next 5 years. So they achieved the targeted production for the first year, but then there was a change in the second year. And the company wanted to make a revision of the estimates at the third, fourth, fifth year as well. How would you amortize that intangible asset? So pretty simple and straight. I think I'll just run through the answer with you. So at the first instance, we need to consider the, you can say, depreciable amount of the intangible. In the absence, we consider that there is no scrap value. So the entire 1,000 lakhs will be taken. Now, if I use the unit of production method, I just need to take the sum total of the production of all 5 years put together. So 50,000 plus 70 plus another 1 lakh plus another 120 and plus another 1 lakh 10. The sum total of the production is 4 lakh 50. So in the first year, the company would have taken a depreciation amortization 50,000 divided by 4 lakh 50. So if you take 50 divided by 450, it comes to 1/9. So on 100 lakh rupees, if you take 1/9, you can see the first year amortization is coming to this figure. That is based on 50,000 divided by the total production 4 lakh 50 into the depreciable amount. Now, at the end of second year, we have made changes in terms of the production. So let's take a revised estimate of the production. Second year end, the production is 65,000. And there is a change in the third year, 85,000. Fourth year is 1 lakh 5,000. And fifth year is 1 lakh 15. That makes it 370. So now the total of the revised production is 370. Now, since in this particular case, the method, I would say not the method, but the estimate is undergone a change, you need to change on a prospective basis. Get the book value of the intangible. So you can see this is the book value of the intangible. Out of 1,000 lakhs, you made a reduction of the first year amortization. And then you can consider the amortization for the second year. And that's going to be 65,000 production for the second year upon the total estimated production 370. And that's how the amortizations of the remaining years will also take place. I think pretty simple and pretty straight indeed. Okay, so far, so good on this. Now, I guess, friends, we need to do a little comprehensive question with you. Effectively, you can see that my standard is over. I've given you inputs on all the 3-step model, but I think I want to still do a little run through in terms of the January 21 question, because that was a best question, I believe, which came in the exams. So I'm already carrying the suggested answer with me. This is January 21 question. And this was a question number 3B in the paper. I'm just going to read this question and do some analysis as I read with you. I'll just quickly run through the answer with you. It's not a very difficult question, but I think one of the good questions indeed. Now, it says Super Sounds had the following transactions during the financial year 1920. It says on 1st April 19, Super Sound purchased the net assets of music. So this is a case of a business combination. The fair value of music's identifiable net assets was a total of 10 lakh rupee. And Super Sound Limited is of the view that due to popularity of Music Limited, the life of the goodwill is supposed to be 10 years. Okay, I think I missed out saying something to you, but I thought I'll say that in this particular question. Goodwill is another asset which is not amortized. If you look at the provisions in Indus, as far as goodwill is concerned, I would put it under number 4 as well. Goodwill is not supposed to be amortized. Goodwill is also annually impairment tested under Indus 36 every year, even if the indicators of impairment are not there. Just to give you a little knowledge, quite recently, the International Accounting Standard Board, again conducted a review, because earlier to this aspect, goodwill used to be amortized in IFRS as well. So there was a lot of growing demand amongst the industry where they were insisting upon the amortization of goodwill. But quite recently, the International Accounting Standard Board, came up with a view that we are not going to reintroduce the amortization of goodwill aspect. The concept of impairment will continue. So there is only one approach which is allowed for goodwill, and that is a mandatory impairment testing at the end of each year. So in this case, it says Super Sound is of the view that due to popularity of music, the life of goodwill is 10 years. Doesn't make a difference. Goodwill is something which is supposed to be tested for impairment. Then it says another transaction on 4th May, Super Sound purchased a franchisee to organize a musical show from Arman TV for 80 lakhs at an annual fee of 2% of the show revenue. Now, this is something which you have purchased, and this is not a part of business combination, but this is a separate acquisition. So I think you know that you just need to meet 2 conditions. And I think you can see that the franchisee is definitely without a physical substance. And we can definitely say the economic benefits would vary, and the other factors can be easily evaluated. Now, what the company is making a payment is a lump sum amount of 80 lakh with an annual fee of 2% on revenue. The franchisee expires in 5 years, and the revenue for the year 1920 is given, and the projected revenues are also given. Now, the amount which you're going to pay as a percentage of revenue is something which is a revenue expenditure. It cannot be capitalized as a part of the cost of the asset. So when the franchisee will be recorded, it would be recorded only at 80 lakhs. The rest is going to be taken to the P&L as and when paid. Then there is a third one. It says on 4th July 19. Now you can notice something, that we are given different dates when the asset has been acquired. Considering that the acquisition date is 4th of May and 4th of July, what immediately comes to the mind is that amortization will also be proportionately taken. But they gave a very clear-cut input in the question that you're going to consider a full depreciations in that case, irrespective of the acquisition date. You'll see that requirements given below. So it says on 4th July 19, Super Sound was granted, it says, a copyright that has been applied by music. And then it says during the financial year 1920, Super Sound incurred a legal expense to register the patent. So that's a directly attributable cost. And 7 lakh additionally cost to successfully prosecute a copyright infringement suit against a customer. Now, the money which you're paying to the lawyer to get the patent registered is certainly directly attributable. But the money which you're paying additionally to prosecute against an infringement suit is not something which is directly attributable. That's going to be taken in the profit and loss account. And the life of the copyright is 10 years. Super Sound follows an accounting policy to amortize all intangible assets on a straight line method or any appropriate basis over the maximum period permitted by relevant Indus. And at this stage, let me also tell you that when you amortize an intangible asset, and specifically if it stems out of contractual or legal rights, the depreciable life, the useful life of the intangible asset should generally not exceed the contractual life as well. So you can say that even though the intangible assets may have a useful life, but then considering that if it stems out of legal or contractual rights, we generally consider the useful life as the legal limit itself. So whatever is the period for which the right has been given, that would be considered as a useful life. So it says the company takes an amortization on SLM or any other basis. And then it says you are supposed to take a full amortization in the year of acquisition. You're required to prepare a schedule showing the intangible section in the balance sheet of the company for the year ended 2020. And we are also required to show certain related expenses that would appear in the profit and loss of the company. The mere emphasis was on the presentation with reference to the Schedule 3. So I think I'm just going to quickly run through the answer of this particular question. So at the first instance, I think let's take you to the notes to accounts in this particular case. Now, in the notes to accounts, we are first making a statement which reflects the position of the intangible assets, the gross block, then the accumulated amortizations, and the net block. So the gross block is reflecting an opening, and additions, and a closing balance. And accumulated depreciations is again indicating the opening, additions, and closing. And the net block is reflecting the opening and the closing. Now, there is no opening balances because this is the first year. So goodwill has been taken at 3,20,000 and there is no impairment applicable because you'll tell the examiner that in this case, amortization is not applicable. You just need to tell him that in this particular case, the only thing to be done is an annual impairment testing. And let's say if there is no impairment applicable, it continues at 320. Franchisee is appearing at 80 lakhs with a life of 5 years. So you get a debris amortization of 16 lakhs and the closing balance becomes 64. As far as copyright is concerned, you've acquired the copyright at 250 with a 10 years life, 25,000 is the annual amortization. So basically, if I now go to the amortization expense, we can say there are two expenses to be taken in the income statement in the P&L. 16 lakh rupees of amortization on the franchisee and 25,000 rupees is the amortization on the copyright, and that money which you paid in terms of, you can say the infringement cost which is paid and the amount which is paid against revenue, that is to be taken as an expense in the P&L. So whatever money was paid as a percentage of revenue for the franchisee right goes to the P&L, and the money which was paid for the infringement purposes also goes to the P&L. What you paid to register the right is a part of the cost of the asset. So this is how the expense in the income statement appears. Now you can see the extract in terms of the balance sheet and the extract in terms of the income statement. In the balance sheet, you just need to tell the examiner that this is going to be part of the non-current assets. And in the non-current assets, you've got intangible assets, the sum total of the assets, which is goodwill, as well as the amount. Though I think technically speaking, if you ask me, that goodwill, could have been reflected as a separate item as well, because in Schedule 3, goodwill appears as a separate line item. So maybe, we could have segregated the goodwill and the other intangible assets. In the profit and loss account, we have reflected revenue because the revenue information is already given. So revenue is being reflected. The amortizations has been reflected and the other expenses, which is in terms of that expense revenue, a percentage of revenue paid and the infringement right, that appears as another expense. So the question was pretty simple and straight, except that was, a little stress in terms of the presentation of Schedule 3. Right, friends. So I think that brings us to the end of this particular standard as well. And I think before I end for this session, I'm not giving you any MCQs on that because this is the end of this particular topic. So we may not be able to discuss those questions with you. But in any case, I think, first of all, let me, give you inputs on, what you need to revise in the standard. Now, since the standard is done, I would first of all say that, go through this particular standard, revise the 3-step model, carefully have a look at the parameters, remember the negative list of items, and also carefully go through the definition and the recognition parameters. then go through the list in terms of, if I just mind map the things, just go through the list of, the parameters which narrow down the condition. So I think the core area in terms of the standard is your step one. You need to be very focused, clear on what is that negative list. And then and the negative list is comprising of those 5 items. Then your focus needs to be clear on what are the 5 parameters for definition and recognition. And you should be very clear that for intangible assets which are acquired separately, or intangible assets which are acquired in a business combination, how does the list get narrowed down? Then what conditions need to be evaluated in that case? And once that first area is done, then you look at the second area, that is on the measurement aspect. And we've done a lot of permutation combinations on that, especially when you look at initial recognition. We looked at a separate acquisition, also indirectly a case of deferred acquisition. And I think when you're looking at deferred acquisition, you know that we're also applying the concept of unwinding of discount in those cases. Then assets acquired under a business combination, then under government grant, and the concept of exchange, which is a little typical one. Subsequent measurements using a cost and a revaluation model, and the considerations which governs a revaluation model. And then finally, how do you take care of the amortizations? Which intangible assets are annually impairment tested, mandatory, and which are supposed to be amortized on an annual basis? So practice the questions from the study material and practice the questions from the revisionary test papers, mock test papers, and you'll feel certainly confident on the standard. Right, friends. So I think that brings me to the end of this. And Shobham, sir, thank you very much, sir, for the session in intangibles. We'll revise and ask doubts if any. You're most welcome, friends, on that. And Rashmi, really good session, sir. Charts, you're just great for mind mapping. Thanks, sir. Thank you so much, Rashmi. That means a lot to me. So I'll be looking forward to meet you all, maybe for a couple of sessions in January and later. So as of now, I take leave from all of you, friends. So good to have you all. Thank you. Bye-bye and take care on that. Thank you, friends. Thank you so much. And bye-bye and take care.